Telling CNBC we're in unprecedented times.
There is a huge amount of uncertainty in the global economy right now. So even for ourselves, in terms of figuring out where the global economy is going, we had to take a slightly different approach than we usually do.
And SAP shares are called sharply higher after posting a first quarter operating profit, but profit beat. CEO Christian Klein telling me tariffs do cloud the outlook.
It's hard to say, it's hard to predict, but we remain optimistic given what we see in the market, what we hear from our customers. And look, at the end, this is what we can influence. That is what SAP can focus on, the success of our customers.
Right, really nice to see you all this morning. There's a lot going on. Let me just briefly summarize what happened overnight in case you've been under a rock or on Mars or something. A man who couldn't be fired by the president is now not going to be fired by the president. A trade war between China is at its high, even though there are no talks going on between the Chinese and the US. And a man who's working for the government who's got another couple of companies to run, has now said he's going to spend less time working at the government and more time on his companies. But his shares rallied aggressively, despite the fact that the numbers were woeful and plummeted. I'm talking, of course, about Powell, China trade wars, and Tesla as well. So there's a lot of hope rather than fact of why these markets move so aggressively. But let's go into some of the detail. President Trump says he's not planning, it's got two asterisks around it, my prompt, not planning to fire the Fed Chair Jerome Powell. His latest remarks come just days after lashing out at the central bank chief, describing him as a, quote, major loser. Wow. And writing on social media that Powell's termination cannot come fast enough. Speaking to reporters after a ceremony to swear in Paul Atkins as the chair of the U.S. Securities and Exchange Commission, Trump explained his decision.
The press runs away with things. No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not, but it would be good timing.
Speaking at the IMF World Bank meetings in Washington, D.C., the ECB President Christine Lagarde acknowledged the tough position Mr. Powell is in.
We're both used to political pressure in one way or the other. But as I said, I have immense respect for the work that he does and for his loyalty to his job and to being as diligent, disciplined as possible to deliver on his mandate. For him, I think, I'm sure, as it's for me, the mandate is our compass. We have to deliver on our mandate.
Let's take a look at the U.S. futures. Big gains called for the Nasdaq, the S&P 500 and the Dow Jones. This is after yesterday. We saw some really big moves on these markets. Again, I think there was a lot of hope. I think it was about positioning. I think it was about a bit of profit taking from the bears. I think it was about profit taking on the bears on the dollar as well. We'll come to the dollar in a few moments' time. But in terms of the U.S. equity markets, look at that. It's always a big number, isn't it? 1,000 points on the Dow to the upside, back up to 39,000, 2.5% higher for the S&P and 2.7% up for the Nasdaq. This was broad brush. Russell 2K was up 2.7%, the Dow Transports up 1.5%, financials leading the way on a sector basis. They were up 3.3%. Incidentally, the worst performing sector was consumer staples, but it was still up 1.6%. Dollar crosses. It's been a one-way trade this year. I sell the dollar pretty much against most other currencies. But actually, that's been reversed with the dollar index just having a 0.66% rally yesterday, 1% gains for the greenback on various currencies. And it's the same move this morning. As you can see, the euro losing ground, the pound losing a little bit of ground, and also the yen and the Swiss franc. The treasuries haven't moved that aggressively, actually. We had a 440 handle yesterday. We now got a 436 handle. So if you round it up, we're still at 4.4% on the 10-year. The short-dated 2-year paper trading at 3.8%. Asian equity markets also, by and large, I say by and large enjoying the rally, a really tempered move on the Shanghai Composite. Elsewhere in Hong Kong, in Tokyo and in Seoul, we're seeing some pretty solid gains, but the Shanghai Composite barely moving despite those comments, which we'll revisit from Besson and indeed Trump, that actually there is a deal to be done. The European futures look really positive if you're long. I never forget it's a two-way market, so I'm not quite as ebullient as some people you might hear saying, oh, market's going up, oh, that's good. Market going down, that's bad. I don't always agree with that. I think there are times and horses for courses, so to speak. But the DAX futures called up 2.5%. What is interesting about that one, I'll specifically hone in on the DAX, is it's partly about the individual corporates. Most of this is about the broader macro at the moment, no doubt about it. But SAP, Christian Klein's group, and we just spoke to him, has had some really big numbers, and I'll revisit that in a short while as well. But they're called up 10%. They are the biggest European company at the moment, in part because some of the other big companies are having such a dreadful time. LVMH, Novo Nordisk, which were our previous champions. Okay, so let's move on to these comments, because a lot of the turnaround was because of this. Tuesday's market turnaround came after President Trump talked up relations with China, signaling the tariffs will drop substantially.
145% is very high, and it won't be that high. It's not going to be that high. It'll come down substantially, but it won't be zero. It used to be zero. We were just destroyed. China was taking us for a ride, and just not going to happen. It's not going to happen. We're going to be very good to China, have a great relationship with President Xi.
Okay, but just one step back before I get to our guest, and I'll do the next read as well. You've got to talk to each other. It's all very well saying it's not going to be that high. It's not going to be that high. But the Chinese are really fed up about this. They've accused the US on a daily basis of bullying. You know, someone's got to start the time. As far as I understand, if you know better, message me. You know how to get hold of me. I don't know if there's any talks going on. The market doesn't know there's any talks going on. The market hopes that that's it. The rally was also triggered in part by remarks that the US Treasury Secretary, Scott Bessent, reportedly made at a closed-door event hosted by JP Morgan Chase, where he said that the tariff standoff with China cannot be sustained, and he expects the situation to de-escalate. Well, Klaus Bader, I think he's in the same situation as me. He's Global Chief Economist at Societe Generale. Klaus, lovely to see you. It's all very well saying that, but they've got to talk to each other first. Markets being bought, I think, on hope rather than fact at the moment, isn't it?
Yeah, well, I mean, you know, it's all about tone, right? In German, they say the tone makes the music. And I think that that's exactly it. It's been until now just this super aggressive strategy, which, you know, borders on the complete irrational. 145% tariff effectively means that trade should, under all normal circumstances, cease. The trouble is that China makes a lot of goods, which the U.S. certainly in the short term cannot substitute. Now, about your question of talks, there is, of course, a golden opportunity here, and that is the IMF meetings. China has sent a relatively high-level delegation. The U.S. will be present, and so at least on the second level, there will be talks. What seems clear is that the Chinese government, and in particular Xi Jinping, is only interested in a top-level meeting if it is well choreographed, and he's not going to be faced with something unexpected. You know, you wouldn't expect something as unexpected as Mr. Zelensky experienced in the White House, but it's going to be extremely well prepared. But as I said, there's a great opportunity here at the IMF meetings to de-escalate this situation and, you know, kind of return to the floor of reality, because what's been coming out of the Trump administration really borders on the irrational.
It borders on the irrational. So, for a start, Klaus, hand on heart, I couldn't do your job in a million years. It's very difficult disseminating what's going on in normal times, let alone what's going on with these absolutely irrational times. But Klaus, you don't know any more than I do, I think, what is transactional, what's, you know, as some of the sycophants would call it, like Ackman, the art of the deal, or what's here to stay. None of us do we?
No, we don't. And you're absolutely right. It's not been easy doing this job recently. The difficulty is that rational arguments have, in recent months, not really carried the day. But I think in the end, there is, the only way you can approach economic management is through a rational framework. Trump has his agenda. And he's not going to completely bid farewell to it. But, the kind of process that Trump talks about, which supposedly is his real goal, which is to bring back jobs into the U.S. Now, I'm a skeptic as far as that as the possibilities and the breadth of that is concerned. But even to the extent that it will work, it'll take years. And during that time, imposing high tariffs is going to exact a high price on the U.S. economy. Now, where exactly it falls, to what extent it falls on the margins of importers, on the margins of retailers, and on the head of the consumer, i.e. through higher final prices, is open. But what is clear is that you see, the thing about tariffs is they are not infinitely scalable. A beautiful example is the threat of imposing 200% tariffs on the importation of any European alcoholic beverage into the United States, which was threatened at a point. Well, if that happens, the trade just stops. And therefore also the revenue that the U.S. gets from it is zero. And neither of those are things that the administration really wants. What, coming from this administration, what is negotiation gambit and what's real policy is totally impossible to tell. And people have different opinions. And it's one of those things where reasonable people can reasonably disagree. All we can hope is that in the end, the cooler heads will prevail. And I guess Scott Bessent is one of the cooler heads there. And so I think he's the one that one really needs to listen to.
Yeah, we're all excited about the guardrails, aren't we? The fact that Trump 47 may well have some guardrails rather than it just being very different from Trump 45. Klaus, you know as well as I do, this market will overreact in either direction. Always has done in our careers and always will do. So if there are substantial talks with the Chinese, and if the 90-day hold-off with the rest of the world turns into something more substantial and longer term as well, I know for a fact, as you do, that the market's going to go gangbusters to the upside. But is the damage from these policies already done? And although the worst-case scenario may be averted, actually, this distrust now of the oscillating US administration's attitude to the rest of the world, is that going to create problems which are more longer term?
Well, it's certainly going to cause developments which are longer term. It's absolutely clear, I would say, that the US allies, or what we used to consider the US allies, they're going to be spending a lot more on defense. They cannot rely to the same extent as they did on the US security guarantees. There's also, the unraveling of global trade isn't going to return to where it was. And so I think that I've argued against this idea of deglobalization for a long time. Yet at the same time, what I think will happen is that global trade is going to shift. Global trade flows are going to move differently. And the United States, we should stay also, the United States isn't going to play the role that it did. In the sense, it was never that big. The U.S. accounts for about 14% of global imports and about 8-9% of global exports. It is not totally dominant. What I would say is that it's been a little bit of a wake-up call. The United States stock market has outperformed for years everything in sight. So that before this crisis started, the U.S. market cap accounted for 70% of global stock market capitalization. That strikes me as absurd. And the US dollar has also been very, very highly valued. And a lot of other currencies have been very undervalued. Are we going to return to the position where we were? I think almost certainly not. But I could be wrong.
Well, we could all be wrong, Klaus, on this one as well. Look, hey, one thing that Trump is right about is how Europe spends its own money on looking after itself. And it is very, very clear we lack something here in Europe as well. So I'm hoping the best thing that can come out of it for our continent that we both love is actually Europe does all the things it's been talking about for a long time and actually starts looking at the Letter plan and the Draghi plan and actually does carry out some action rather than fine words as well. Do you think that's going to happen under this commission, Klaus?
Yes, I think I do. And the reason is very simple. The European Union moves forward in crisis. And this is a crisis. And I think it's a crisis which only a pretty united Europe can tackle now. There are, of course, some countries which take a slightly different line. Hungary is one often quote example, but, you don't need to drag along every single member. Yes, I do think that Europe realizes that it just cannot rely on the United States the way before it did Trump 1.0. And it's going to have consequences at all kinds of levels. I already mentioned military. I think it's going to have consequences in terms of research, in terms of infrastructure spending, and it's going to have consequences for driving forward just European innovation. One of the things that concerns me so much about what this administration is doing in the United States is in its effort to completely reshape the federal government. It is slashing funding for universities, for research outreach, for U.S. agencies. And I think this will seriously endanger the leadership of the U.S. in innovation and in the advancement of scientific knowledge. And it would be good if Europe, and it has the ability, I believe, at least partly jumps into that breach. That would be something I would love to see.
Yeah, that would be very interesting, wouldn't it? Klaus, let's have this conversation on another occasion, hopefully when you're round our brand new set, which we will start on Monday. So we've got a whole new show as well. Klaus, thank you very much indeed. Lovely to see you. So Klaus Bader, Global Chief Economist at Societe Generale. Did I mention that we've got a big move coming on Monday? Yeah, whole new look squawk box as well. Very, very exciting. There might be 3 anchors. Right, moving on. Elon Musk says he will pull back from his work with the Trump administration after Tesla posted its biggest revenue and earnings misses in half a decade. Net income at the automaker sank by nearly 3/4 on the year, coming in at just over $400 million in the first quarter. That's $1 billion drop. Meanwhile, revenue came in at $19.3 billion, nearly $2 billion below expectations. In better news for the company, gross margin ex-regulatory credits came in higher than expected, but the figure is still at a multi-year low. But it was Musk's announcement that he will pull back from government work that moved shares in extended trade, pushing them sharply higher. On the call, Mr. Musk gave his take on the Trump administration's tariffs.
Tariffs are still tough on a company when margins are still low, but we do have localized supply chains in North America, Europe, and China. So that puts us in a stronger position than any of our competitors. I'll continue to advocate for lower tariffs rather than higher tariffs, but that's all I can do.
Coming up on the show, the IMF slashes its global growth forecast this year, citing a major negative shock from Trump's tariffs. So we'll have plenty more after the break.
Hello everyone, I'm Julie Sweet. Welcome to another edition of Reinvented with Accenture. Today is a very special episode. Normally we're talking about reinventing a company. Today we're talking about reinventing a country.
Payments have to be fast, they have to be secure, they have to be convenient, and they have to be inclusive. Those are things which are not negotiable. And when you think about it, there is no single commercial transactions which doesn't rely on a payment at some point.
Want to jumpstart your side hustle? Learn the skills to earn passive income online with CNBC Make It's new online course. Expert advice, real-life success stories. Register right now at cnbcmakeit.com/passive income.
If you're really ambitious, you don't think about the end goal. You're too busy thinking about the process of getting there and the growth that you need to achieve. And nothing can beat that.
Inside the world's most cutting-edge technologies.
We're seeing a real opportunity for those with brilliant ideas to accelerate towards change.
Discover the secrets and turn innovative ideas into profitable ventures.
Our vision is a world where human prosperity and economic growth are planet positive.
Embrace digital disruption.
I mean, this is life-changing technology.
CNBC Tech, The Edge, only on CNBC.
Frank Holland, Worldwide Exchange, CNBC.
Not the biggest shocker you're ever going to hear, but the IMF has now slashed its global growth forecast for 2025. Why do you think? Yeah, they've warned of a major negative shock from, of course, Trump's tariffs. The US was handed an almost 1 percentage point downgrade from January forecasts. That's huge. The IMF also lowering expectations for other major economies, including the United Kingdom and China. Well, Caroline spoke to Pierre-Olivier Grinchard. What a great name. He's the IMF chief economist in Washington and asked about the downgrade.
There is a huge amount of uncertainty in the global economy right now. So even for ourselves, in terms of figuring out where the global economy is going, we had to take a slightly different approach than we usually do. We basically established that reference forecast based on all the policy announcements up to April 4th. So that's after the Rose Garden announcement on April 2nd by the U.S. administration. And then we looked at the world based on this set of assumptions. And what we see is a fairly significant downward revision for growth in 2025 and 2026. We're seeing growth at 2.8% this year and going back to 3% next year. But overall, the cumulated downgrade is 0.8 percentage points. So that's quite significant.
Meanwhile, President Volodymyr Zelensky said Ukraine is ready for talks with Russia in any format once a ceasefire is set. Meanwhile, Russian President Vladimir Putin has reportedly offered to halt the invasion at the current front lines, according to the Financial Times. Diplomats from the UK, France, Germany, Ukraine and the US are holding talks in London today aimed at securing a ceasefire. The US, meanwhile, is proposing to unofficially recognize Russian-controlled areas in Ukraine, according to an Axios report. The plan, part of a peace framework that would see the US lift sanctions on Russia and a small part of Russian-occupied Kharkiv returned to Ukraine, was presented last week. The US is expecting a response to the proposal today, which they have stated is President Trump's final offer. Spain has vowed to hit NATO's defence spending goal of 2% of GDP this year. That target, by the way, was agreed on by NATO. When do you think, if you didn't see me talking about this earlier, when do you think that target was agreed, ladies and gentlemen? Yeah, 2006. Anyway, Spain's Prime Minister Pedro Sánchez said the country would contribute to defending Europe as he brought forward Spain's previous self-imposed deadline of 2029.
Nuestro objetivo es modernizar.
Our objective is to modernize security and defense capabilities in Spain and Europe with a comprehensive 360-degree perspective, mainly focusing on three things. First, the improvement of the conditions of our armed forces. Second, the modernization of our equipment. And third, the development of new technologies, with a priority focus on those dual-use applications and devices that can serve both military and civilian purposes.
Speaking to our very own Caroline in Washington, D.C., European Investment Bank President Nadia Calvino said countries across Europe are doing more to strengthen security.
Unfortunately, because I would really wish, that we were not having these conflicts very close to home. But unfortunately, it's clear that we need to reinforce and step up our support to Europe's security and defense capabilities. Last year in 2024, we started to get ready and expand our mandate. And this year, we have expanded it further so that we will ingrain security and defense as one of our core objectives in all our projects. And we will certainly increase our financing in this area. We doubled our investments last year. We are expecting to more than double in 2025 again and make a difference in terms of the security and the strategic autonomy of Europe in these troubling times.
Can I ask you, though, you have a balance sheet of around 600 billion euros. You, as you say, want to double the financing for defense to 2 billion euros this year, 2025, up to 8 billion in a few years' time. If you take that into perspective, given the size of your balance sheets, these numbers still look relatively small. Shouldn't more be done on this front?
Well, financing is not the constraint right now. We are working on a very solid pipeline of 22 projects, which I hope will be approved in the coming months. We have recently also removed the 8 billion ceiling, so we will be able to respond to the needs of the European Union right now and contribute, together with other institutions, to reinforce Europe's capabilities. But let me argue that I think that every euro financed by the European Investment Bank is actually contributing to Europe's security, because security starts with a strong economy, and our investments in energy infrastructure, infrastructures, in research and development, new technologies, water. All of these investments are making Europe stronger and contributing to a safer, more stable world.
Can't really argue with it, can we? That I would like to see someone try and argue that Europe has just sat back on its defence and relied on the Americans. Now, there was a time when that was necessary, post-Second World War, but let's be honest about it. There's no excuse this century whatsoever for Europe failing to defend itself. I'll tell you one country that has spent billions rearming and is spending more than America, more than anyone in NATO, I think. That's the Poles. They're building a big army now. Now, Caroline sat down with the Polish finance minister, Andrzej Domanski, and asked what Europe needs to do on defence spending.
So it's obvious that Europe must take more responsibility for our own security. And this is why Poland spends close to 5% of our GDP on defense. This is why within those 5%, we have the highest share of money that is actually spent on buying new equipment. And we are asking our European friends to do the same, to increase their spending. It's not easy. We know that budgets are tight, and some countries face fiscal challenges, but some action is really needed. And this is why we welcome the recent proposal of European Commission to provide up to 150 billion euro of loans for countries, for example, for joint procurement. It's clear for us that we want to not only to spend more, but we need to spend wisely. We need to try to buy as much as possible for the same amount of money. And the recent proposal of Commission is very good. Having said that, we believe that some further steps are also needed.
Such as?
Such as, for example, special fund, maybe rearmament bank. We have a strong priority for European Commission proposal, as Poland is right now a presidency, and we need to focus on what's on the table right now. Having said that, we are discussing other options with some countries, and we know that not all member states will be willing to participate. Therefore, it's also possible that it would be like a coalition of willing.
The coalition of the willing. Do you foresee joint borrowing when it comes to defense at this point in time?
We are not discussing the joint borrowing right now. We welcome that some countries, like Germany, they changed their policy in terms of spending, also on spending on defense, and this is very important. But joint borrowing is not on the table right now.
The Poles aren't waiting for the Americans to spend money on European defence. They're doing it themselves, which is a fascinating case study anyway. Right, okay, European equity futures. We are 30 minutes away from the start of equity trading. The DAX led by SAP, and it's going to be a blockbuster to the upside on SAP. At the moment, we think. So anyway, 2.3% higher. That aside, north of 1% gains across the continent. We'll bring you those numbers in 30 minutes' time.
How much would you pay for luxury travel? A week's stay costs almost $270,000.
It's on the list for $30,000.
From secret getaways to one-of-a-kind deluxe experiences and bespoke services all the way.
The next evolution of the luxury traveler is experiences. Experiences really that money can't buy.
This is First Class, only on CNBC.
CNBC has the most affluent audience in television, and my job is to tell viewers how the wealthy make it, spend it, and give it away. I grew up in upstate New York. Both my parents were artists, so we didn't have money, but they taught me to appreciate beauty and also see things a little bit differently. For a lot of people, their ambition is to get wealthy, but money itself doesn't have any meaning. It's how you make it and what you do with it that gives it purpose.
Want to make some extra money but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea. Get expert advice and hear real-life success stories.
Soon, you'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today.
A very warm welcome to Scorebox. I'm Steve Sedgwick. On St. George's Day, if you celebrate those kind of things, these are your headlines. European futures are called sharply higher with the DAX leading the charge. Well, partly because of Europe's largest company, SAP, pointing to a double-digit gain at the open after posting a first quarter operating profit beat. But the CEO, Christian Klein, tells me tariffs cloud the outlook.
It's hard to say, it's hard to predict, but we remain optimistic given what we see in the market, what we hear from our customers. And look, at the end, this is what we can influence. That is what SAP can focus on, the success of our customers.
Right. Donald Trump changes his tune on Jerome Powell, he has for now anyway, insisting he has no intention of firing the Fed chair after all. Okay, calming concerns over the Fed's independence and prompting a spike in U.S. futures.
The press runs away with things. No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates.
And Tesla shares spike in extended trade as Elon Musk says he's going to step back a bit from his government work after Tesla's net income sinks by nearly 3/4 in the first quarter of the year for its biggest earnings miss in half a decade. Okay, let's take a look at where the dollar is currently. Look, the dollar's on the front foot. We haven't said that at all this year, really, have we? Dollar index, I'll just get straight to that as well, which has been trading down, 7 to 9% so far this year. Currently on the front foot, 6% lower now, up 0.3%. Speaking to Carolyn on the sidelines of the IMF meetings in Washington, D.C., Pierre-Olivier Granchard, chief economist at the IMF, said the weakening of the US dollar does not signal a major change in the system.
What we're seeing in terms of the dollar, you have two forces going in opposite directions. One, you have the tariffs. In past episodes, when the U.S. would impose, for instance, tariffs on China a little bit less than 10 years ago, what we saw was an appreciation of the dollar against the Chinese currency. So a lot of people were expecting that this round of trade measures would lead to an appreciation of the U.S. dollar. We've seen the opposite. Why is that? Well, there are the forces that we can point to are weaker growth prospects in the U.S., a lot of uncertainty about policy going forward. And that leads to a reassessment about the demand for global dollar assets, not just about bonds. It's bonds, equities, all kinds of dollar assets. Now, remember where we're starting from. The narrative a few months ago even was about the strength of the U.S. economy, tremendous amount of capital flowing into the U.S., going to equity markets, but also going to bond markets. So there is some reassessment of that. What we're seeing is some rebalancing. The markets are adjusting, the valuations are adjusting, the currencies are adjusting. All of this to us at this point seems fairly orderly. So we're not seeing a major change in the system.
So the US dollar remains the world's reserve currency, you think?
At this point, certainly.
Slightly different story for you now. UK currency risk management firm Argentex is in advanced talks with privately owned firm IFX Payments over a potential offer. Shares were suspended ahead of Tuesday's trade as the company flagged a significant impact on its liquidity position from forex volatility. Wow. In particular, the rapid fall of the dollar in recent weeks. Well, Do you know someone who I haven't seen for ages and who I've spoken to many times over the years is Thanos Pampakidis, who is Global Head of GTN FX Strategy at Bank of America Global Research. Thanos, where have you been?
It's been extremely busy.
I know you have. I mean, you've had one or two things on, but you and I have been talking for at least a decade, I think, haven't we? Look, we have been talking for at least a decade, and you and I are of a similar vintage. We've been around the traps a while, shall I say. Is anything, and people use this kind of hyperbolic language, but is anything we're seeing at the moment unprecedented in your career?
Quite a lot. Definitely the policies that the new U.S. administration is following are moving the U.S. in a direction that nobody could have imagined. Very unconventional policies, particularly for the U.S. And as a result, the way the market is trading is unique because it is the first time that we see in risk-off U.S. yields are rising and the dollar is falling, which is consistent with the market selling everything in the U.S.
Let me just remind viewers what you just said, because this is huge if that's the case. In a risk-off scenario, the dollar has been a go-to in our careers. The US bond market has been a go-to in our careers. If that is now questionable or actually not part of the risk-off scenario, buying these assets, that means an awful lot in FX world and just generally in the global flight to safety, doesn't it?
Yes, indeed. It's a very unique kind of market regime. The starting point is important because we start the year with US exceptionalism, the market being long on the dollar, cherry-picking growth-friendly policies in the new administration.
You mean the tax cuts?
Yeah, tax cuts, the regulation, and now actually we're getting a stagflationary policy mix, which is negative for the dollar. Also, having the US imposing tariffs against everybody else is more negative for the US economy than for the rest of the world. And the overall policy uncertainty, including on fiscal policy in the US, leads to questions about the long-term outlook for the dollar and its status as a global reserve currency. The latter is more a risk.
Okay, so again, you've probably shut me down on this one, just like every other FX strategist for years, about whether the US will lose its primus inter pares, its first amongst equals, its reserve currency status, that whether transactions will occur without the dollar as well. Are you now saying, like a lot of people are now questioning, that the primacy of the dollar is meaningfully in question at this stage of the 21st century?
This is not what is driving the outflows yet. It has to do with the policy mix and the stagflationary risks. But if the US proceeds with these policies, and at the same time we have reforms in Europe that make the euro an attractive alternative, we might be seeing a scenario in which not necessarily the euro will replace the dollar, but the importance of the euro could increase.
What about non-dollar transactions? It's been a red herring for my entire career. Oh, it's going to be, no, everyone's going to stop using the dollar now. I can't see it yet, but are you seeing anything meaningfully with South-South trade or whatever it may well be, ex-dollar?
Not yet. It is very early. I mean, these are moves that can take years, but obviously the US policy turn towards an unconventional territory is happening very fast. So far, we just have the unwinding of the US exceptionalism trades. We have not seen, when we look, for example, at global central bank reserve managers, they are not selling the dollar yet. If anything, they are imbalancing, and as the dollar is weakening, they are buying the dollar. The first step would be for the central banks to stop rebalancing, stop buying the dollar, and then to start selling it. But these are moves that will take time, and the market is still expecting that, at least in some areas, the US will take some steps back on the policies that have been announced.
Loads of presidents I can think of would like a weaker dollar to improve their exporter profile, but always talk a strong dollar. Is there anything on purpose about you're seeing from this administration that wants to weaken the dollar? Because it works for your exporters. It doesn't work for the fact that you import a vast amount more goods than you sell. And also, if there is a policy of buying less from the rest of the world as well, then that means there's less dollars to recycle, which again is a very dangerous policy, considering the twin deficits that the US exists alongside.
Although parts of the U.S. administration have expressed the will to see a weaker dollar, I don't think this is what is driving it.
Right.
I think the weakness of the dollar has to do with the loss of confidence because of these unconventional policies, overall policy uncertainty, and the stagflationary scenario in the U.S. So it's not weakening for good reasons. It is likely to coincide with an overall weakness in the U.S. economy.
Okay, let's get to the bit of the interview where you tell our viewers your strongest conviction ideas.
We are still bullish euro-dollar. The stagflationary policy mix, even if the U.S. does not go into extreme, will be negative for the dollar. We are bullish on the euro because we are very optimistic on the EU reforms that have been announced, which the market is not pricing yet. Our target for euro-dollar was 115. Where is this target? I think we can test 120.
Right, so 115 was, you now think we can test 120. Okay, that's one very positive trade for the Europe, although tricky for their exporters as well. What else? Give us another trade.
Sterling can do well. I mean, against the euro, it depends on the process of EU reforms, but if we see closer integration with the EU, this can be a positive. Also, if we don't see extreme tariffs, some of the high beta currencies that have weakened or have lagged behind can do well. The Australian dollar is relatively undervalued. We don't like the Swiss franc, but we understand why it has been strengthening so much. But the level is quite attractive to sell, maybe against yen, given that it has reached historic high levels.
Yeah, fascinating. Just a quick word on where the pound can get up to, just for a man who might be going to New York later in the year.
I mean, the equilibrium for cable can be about between 135 to 140, but obviously, depending on what happened in the US, we might see levels that approach pre-Brexit levels, even 150. But a lot depends on the US policy outlook.
In the fall, when I'm going to New York, yeah?
Well, by the end of the year, let's say.
You get me there, I'll bring you back a Big Apple T-shirt. Lovely. Thanks very much. I don't buy the gifts for guests. I don't do that. Thanks very much. Lovely to see you. Thanks, Dan. And nice to see you. It's been a long time. Way too long. Thanos Pampakidis, who is Global Head of G10 FX Strategy at B of A Global Research. Coming up on the show, shares in German software company SAP surge after a Q1 beat. We'll bring you some of our interview. I say our interview, it's my interview. Coming up next.
CNBC. Live ambitiously.
You want to talk business? Meet me in the Onboard Lounge.
Watch the markets open. Brought to you by Emirates.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Next on Unlocked, dramatic renovations.
I'm not sure we would have done the renovation in the beginning if we'd have known what it was going to take.
Three friends bought an abandoned high school and transformed it into this apartment building. A couple turns an absolute wreck into their dream home, then say goodbye to electric bills. A 117-year-old house gets the total recharge. Now it unlocks more energy than it consumes.
Getting rid of gas and moving to a completely electric building.
Next on Unlocked.
I've always had an ambition to do something I love. I actually got my degree in hotel and restaurant management, but I had a thing for numbers, and that's how I got onto Wall Street. I became a trader. I traded all different kinds of asset classes. The energy in a newsroom when there's a big news day out there feels a lot like the energy on a trading desk on Wall Street. There's a lot of activity. The stuff we do at CNBC means so much to so many people, because it empowers you with knowledge and with everything that you need to make the right decisions.
Breaking news, market moves. Scott Wapner from the NYSE. Closing bell, CNBC.
Chinese EV maker BYD is reportedly overhauling its European operations amid strategic mistakes. This according to Reuters, which cited sources familiar with the matter. The car maker reportedly ran into problems expanding its dealership network and was slow to offer hybrid vehicles in certain parts, but hopes to put that behind it by hiring executives with local market knowledge. I mean, that's fascinating because you look at BYD and you think they're just going great guns. It's interesting to see they haven't quite delivered on their strategy. Now, more than 70 Chinese and international car makers are showcasing their latest models at the Shanghai Auto Show this week, intensifying what's already strong competition in the EV space, albeit with one big name conspicuous in its absence. Lin joins us live from Shanghai with more. And genuinely, I know you think I was joking. I genuinely didn't know that Tesla wasn't there, Lin.
Yeah, so Tesla is not here, Steve, this year. And that's been a trend we've seen in recent years from this company. The last time that they did showcase in China was 3 years ago, and during that time there was a single protester that stood up on one of their vehicles complaining about safety issues. So we don't know why they're not here. What's also interesting as well is that those major Korean automakers, Kia and Hyundai, they are also not showcasing here today. But I am tracking a couple of really key themes. It's just a fascinating time when we're talking about the auto industry. It's about this intensity of the competition, as you were highlighting there. Also the trade situation, given the US tariff policies, and also domestically here, there's a debate reigniting about safety as well after the Xiaomi SU7 crashed while the vehicle was engaged in driver assistance mode, and it killed 3 people. So it's a very tragic accident, and off the back of that there have been a number of new regulations that have been brought in, which has affected the way that some of these EV companies that are really focused, as I was saying to you earlier, on that digital experience and on a lot of the automation parts in the way that they are able to market. But let's just talk about the competition, because of course you were just talking about BYD, an absolute market leader here in China. And interestingly, this week as well, we're getting these news reports on the battery, which of course is the heart of an electric vehicle. It comprises about 30 to 50% in terms of cost. Last month, BYD really sent shockwaves across the industry when it said that its latest charging system could charge a full tank in 5 minutes. And this week we heard from the biggest battery maker in the world, Contemporary Amperex, or CATL, and they're looking to one-up that. They're saying in 5 minutes they can do the same but at an extended range there. So that really underscores the state of the competition. As one executive described to me, it's like a fitness gym. You're either in the gym or you're at risk of, basically not being able to survive. The other key issue, of course, that I've been speaking to a lot of executives about is on trade. Certainly, in terms of the US market, they say they weren't in the market even prior to the president coming in, and now it feels more closed off. And for them, given just how intense the competition is here, and given also, when you look at the state of the Chinese economy and also the health of the consumer as well, that, when it comes to scaling, when it comes to growth longer term, they do need to look at external markets. I got a chance to sit down with the CFO of Zeekr Group. So Zeekr makes premium EVs. They tell me that they see their main competitor to be Tesla, and I was asking the CEO Jing Yuan about the impact of the EU tariffs on his company. Let's watch.
It does have some negative effects on our sales in the European Union countries, and it is an extra tariff put upon the EVs that we sold over there. But I think we're tackling this question in 2 fronts. On one front, after the acquisition of Lynk & Co, which is mostly a plug-in hybrid maker brand in China, we are actually planning to sell more plug-in hybrids in Europe, which is not subject to the additional tariffs on EVs. And B, we are adjusting the product we offered. was adjusting the specs we offered in the European Union market and trying to see, if we can remain competitive in that particular market. And, there's always plan C, right? The plan C is obviously local manufacturing, and we are very actively discussing with all potential partners within Geely Group, or outside Geely Group, trying to find a way to do local manufacturing as well.
And we know, when I'm speaking to him and other executives as well, that they are welcoming the fact that the EU and Beijing are talking about these duties and potentially coming to some agreement, perhaps in terms of minimum prices, which, for a Zeekr brand, which is premium brand there, is something, that they welcome. But of course, the concern here, Steve, is oversupply. Oversupply has been already an issue we've been talking about for years, but certainly I wonder, how the industry feels in Europe at the potential of that being exacerbated and the impact that will have on the industrial base as well.
Lynn, lovely to see you. Very exciting. Thank you very much indeed for that. German software company SAP beat earnings expectations in the first quarter despite cloud revenue coming in shy of estimates. Adjusted operating profit rose 58% in constant currencies to 2.5 billion euros. Annetta has more on the SAP story. And Annetta, I understand you're throwing to tape of the interview I conducted an hour ago.
Well, I wasn't invited to actually join, while joking aside. So this number set from SAP actually is a very strong one. And given that the strong cost discipline is helping them as well to navigate through that uncertain macro environment, it seems to be as well approved by the share market, by the equity market, because clearly in the pre-market trading we see the shares up by more than 3%. Having said that, year to date they're down by more than 8%. Of course, that's mirroring the weakness in general with tech shares, but still, looking at the numbers now, it also shows that a huge part of their revenues is actually predictable, and that's what Christian Klein also told you in the interview earlier on. Let's listen in.
When I talk about predictability, it's not only a buzzword. I mean, look at our total revenue. It actually consists of 86% recurring revenue. That is predictability. That is resiliency. And I was just, last week in the United States, talked to many customers, and of course they got hit by tariffs. But what they are telling me is, Christian, your software is now more relevant than ever. Why? Help us to manage tariffs in over 130 countries. We are doing business everywhere. Help us to make my supply chain more resilient, which suppliers can still deliver at the costs which I need to still produce my goods at a competitive level. And that, Steve, gives me and the company a lot of confidence also in these times when it comes, for the development, for the whole year. And that's why we also confirmed our guidance.
So for now, the company SAP, the most valuable software company in Europe, seems to be shielded from the impact from tariffs, although they are saying, of course, the uncertainty is high, and there's also part of the business which only accounts for 14% of the revenues, like Ariba, also Concur, which is not subscription-based, and that could be affected by the macro uncertainty.
Don't talk to me about Concur, Annetta. God, blimey, it's the bane of my life. I should explain that I do my own expenses, and Concur is the system which I use. Right, Annetta, what I do want you... For a start, you're always invited to any interview I'm doing as well. So my people will speak to your people next time.
Okay.
Secondly, I did ask Christian about his relationship with the government, and he's really quite optimistic that this incoming government, gets it on spending, on putting Europe in the front of innovation as well. Is that the kind of mood music you're hearing?
Well, actually, there's a lot of hope. And of course, but if you compare that before the start of the last government, there was a lot of optimism as well. So hold your horses until we really see them work together and put some real reforms on the table, and everybody's actually agreeing to it. So for now, there's a lot of, we call it Vorschusslorbeeren, which is like the optimism and also before something is actually happening. So what is expected from that government is really to cut down red tape, to lower energy prices, and to actually incentivize companies to do their investment here in the country. And I guess, as we all know, that business is always about psychology. It could actually change course, especially when it comes to the investment component. If you look at the last 3 years, never before so much capital has left Germany to invest elsewhere, especially when it comes to Mittelstand companies, because there was no lucrative way about thinking how this could actually work in the country, and that is actually changing. And here Christian Klein seems to be the right person to talk about that because he has so many clients.
Yeah, absolutely. It carries a lot of weight when you're Europe's largest company and a company that's had such a dramatic transformation. Annetta, lovely to see you. Thanks very much indeed for that. We'll look at this SAP opening, which is going to be pretty big to the upside, as indeed are the European futures. Let's take a look at those. Germany has got a rocket under it this morning, called up 2.3%.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box. CNBC.
Access Middle East isn't just another finance show.
Do you think about the UAE's trajectory? We actually think very, very long term.
It's a deep dive into the region's shifting power dynamics. What's different about Trump 2.0, particularly for the Middle East? Ambitious economic drive and the personalities pulling the strings.
Tariffs, trade wars, for whatever word you want to use. I think these are all challenging, not just for China, I think for the world.
Join me, Dan Murphy, for Access Middle East, your edge in Middle East markets.
One thing I've learned over the years is don't yell at the stock market. Why do we follow the markets? It's to make money and because it gives us a lens on how the world works. Ambition is the ability to see yourself in the future and to take steps right now in the present to become that future person. CNBC viewers are very ambitious. At CNBC, we are in the dreams business. You're watching to learn something.
A CNBC original exploring equality.
My quote since the beginning was, don't change yourself, change the game.
If you want to be more innovative, more creative, come up with alternative ideas to solving problems, you've got to be more diverse.
And LGBTQ rights and our acceptance are on the line all over the world.
We have something to bring to the table for the solution that we can find together in this fragmented world, and music is always at the center of it.
Real lives, real stories, only on CNBC.
Welcome to Squawk Box. It's 8 a.m. here in London, 9 a.m. CET, and stock markets across Europe are opening up for trade. We're expecting a fairly decent bounce this morning as we open up for the start of the session. A little bit of trade news. We saw that move market stateside yesterday. Hopes that we may see some progress. But of course, earnings in Europe too. SAP out with numbers this morning. We are seeing very strong signals to the upside there. So as we open up, you can see the Stocks Europe 600 bouncing strongly and racing ahead almost 1% straight out of the gate, Steve.
Right, let's take a look at the individual sectors. Every single sector, 11 of 11, were in positive territory yesterday in the United States. Financial stocks were leading us to the fore, and that's exactly which sector, well, one of the sectors, which is on the top form this morning in Europe, 2.3% higher for the banks there. Basic resources obviously responding to hopes that there is some form of rapprochement close between China and the United States. I've got to say at the moment, both the comments from Besant and the comments from Trump are indicating that we're at peak tariffs, that they will not remain at this status quo forever or for a material period. But the fact remains is, to my understanding, to my knowledge, and again, I welcome anybody to tell me otherwise, and I'll be very pleased for you to tell me otherwise, I don't believe there are talks ongoing at the moment. Not meaningful, top-level, leader-to-leader, top-team-to-top team talks between China and the US. So at the moment, I think it's just an aspiration. The last I saw from the Chinese, they were accusing the US of bullying the globe, let alone the Chinese, on trade as well. So the market rallied on hopes that China and US will be talking and that the US is talking in a more peaceful tone about these things. Anyway, oil and gas also moving heavily higher. Brent crude, I can tell you, is now absolutely surging. Something we haven't mentioned too much on the show this morning. 68.40 is where Brent is currently trading, up 1.4%. Technology stocks also moving to the fore. That will be in large part when we get the opening print from SAP, which is quite frankly proving once again that Europe can compete on the technology front if we get the balance right. Individual sectors, I'm not expecting anything in negative territory, but let's take a look at sectors to the downside. Well, I mean, flat on utilities. They are trading around the flat. They are 3 out of 5 of those names you can see on the screen. Food and beverage, telco, and utilities are traditional defensives, and as such are not catching such a bid this morning. Interesting to see what we've got on the opening of the indices so far. Have we got Germany yet? We have got Germany, and that is superb. Actually, the spread bettors and the futures traders, 100% right. I bemoan it when you get it wrong, ladies and gentlemen, but you got it spot on today. 2.5% higher for the DAX. That's exactly what was called. European indices are trading to the decimal where you said they would, where you saw the flow. So well priced, well done. 1.3% higher for the FTSE 100 at 84.34. It was only a couple of weeks ago we were trading with a 7 handle. Other indices look like this. Let's have a look. We've got the SMI 1.4% higher, as indeed is the AEX. A little bit of a laggard performance over in Lisbon. 0.51% higher is where the PSI index is trading, Karen.
Steve, there's a lot of moving pieces here on the stock level, and you can see it's the earnings reaction we've gotten, that's the SAP story, but also some hopes around trade. And what you're seeing on SAP, 9.5% to the upside. Other big moving names, AkzoNobel, 6.3% higher, Lanxess trading higher. Some of the underperformers, and again, it's the same story around what we're seeing on the earnings side. Some of these stocks towards the bottom of the Stoxx Europe 600 this morning are slipping because of that earnings news. If we can switch over the numbers and take a look at the downside, you can see it is the likes of Reckitt Benckiser that's been reporting, Vopak also out with numbers, those stocks disappointing. But some of the other big ones, it is a little bit of a defensive tilt here to the bottom of the boards. Rheinmetall, Hensoldt, some of the names, and Saab, those have been benefiting from this defense story. The pivot towards some European stocks are actually lagging stocks this morning, so they're giving back a little bit of territory. Let's get into the SAP story and that earnings reaction we're witnessing. The German software company beat on earnings expectations in the first quarter, despite cloud revenue coming in shy of estimates. Adjusted operating profit rose 58% in constant currencies to 2.5 billion euros. And let's get out to Annette for more. Annette, this stock is seen as one of the AI names in Europe. Just tell us what we're seeing in its numbers.
I think there's a lot of relief, what we are also seeing in the market reaction, that SAP is actually weathering the storm, be it the macro uncertainties, be it also customers who are actually damaged by the tariff situation. So I guess this is a big relief. And also what we're seeing is that they really deliver on their cost discipline. Last year they announced to cut some 10,000 jobs, and the effects from that are actually just felt in the last quarter, and that's why we also see that huge improvement in the margins, but also the pipeline workout seems to be still intact, and also the fact that they're saying they don't really feel the macro uncertainties weighing on their business is a positive relief, or a relief, I should say, for investors. Christian Klein early on spoke to us, and he explained that 86% of their revenues are predictable. Let's listen in.
When I talk about predictability, it's not only a buzzword. I mean, look at our total revenue. It actually consists of 86% recurring revenue. That is predictability. That is resiliency. And I was just, last week in the United States, talked to many customers, and of course they got hit by tariffs. But what they are telling me is, Christian, your software is now more relevant than ever. Why? Help us to manage tariffs in over 130 countries. We are doing business everywhere. Help us to make my supply chain more resilient, which suppliers can still deliver at the costs which I need to still produce my goods at a competitive level. And that, Steve, gives me and the company a lot of confidence also in these times when it comes, for the development, for the whole year. And that's why we also confirmed our guidance.
So they're also confirming their guidance, which is called quite prudent by some analysts, given that really strong performance in the last quarter. Their CFO just said on the call that, of course, certain businesses, which only account for a fraction of their revenues, like Ariba, Concur, or FieldPass, might be affected also by those macro uncertainties in the future because they are no subscription based, so they're case by case. But in general, I think the numbers set as well, the outlook is showing that SAP is able to weather the storm, and they could actually even benefit from the demand for more cost discipline among their clients.
Annette, the tone there was fascinating from Christian, because that was very similar to COVID when we was talking about corporates relying on the software to manage their supply chains. But what is interesting now as we talk about the future in AI, as he suggests that perhaps some jobs could be lost. What is it, 10,000 jobs under review thanks to the AI story. Just walk us through that.
Yes, exactly. I mean, last year they have announced that they're planning on cutting 10,000 jobs, and I think the bulk of that has been done by really very rich redundancy programs. So having said that, the future is clearly AI for them. They restructured, I think it was last year around the same time as well, the board to reflect that. So they take it really seriously. And I went to Waldorf, I think last year was it as well, or the year before, and I did look at their test facilities where they showcase how AI can actually revolutionize and also streamline supply chain management. It is quite incredible. If that's going to put to work, it will be extremely beneficial for their clients, because AI can actually reflect so much more data points than a human or a normal computer, and that will, of course, increase the cost discipline and cost saving for their customers.
Annette, thank you very much for bringing us up to speed with the earnings from SAP. Meantime, French consumer giant Danone has beat on expectations with their first quarter sales rising 4.3% on the year. Let's get to Charlotte for more. Charlotte, stocks that have been highly favorable in this uncertain environment actually getting a little bit hit today. They're being left behind. Danone is one of those stocks. How much of that is earnings? How much is down to other stocks looking more appealing today?
No, you're right. It's a stock that has outperformed some of its competitors. You look at Nestle, they were down around 8% over the past 12 months. Danone is up 23% over the past 12 months. But certainly this morning a little bit in the red, despite numbers that were better than expected there. They say the bid pricing was price driven, up 2.4%, but also positive volume growth, volume mix growth at 1.9%. That's been one of the key focus of Antoine de Saint-Affrique, the CEO, on the turnaround of the company since he joined a couple of years ago, and try to get back some of the volume growth from the cheaper brands, supermarket brands that some of the consumer turned to when the inflation was high. So try to claw back some of these sales. Looking at the different regions there, there's so strong demand in China. North Asia sales up 9.9% like for like. Their infant milk formula has been doing well. North America up 3.7% as well. There's solid growth led by the high protein products. And again, that's one of the segments of the market that they've been pushing through, kind of a health through food as well. There's in the US some prospects for growth because of the GLP-1 drugs as well. So people that focus on their health, they focus on gut health, they focus on water and yogurt. That's kind of the products that I have, and also on protein-rich products. And some of the products that they've added to their portfolio. Specialized nutrition is another area that had been identified by management for growth. They design food for cancer patients and the elderly. They see this going forward, and this segment was up 5.3% as well. So in terms of tariffs, they said that they're not hugely impacted because they basically use a lot of dairy, a lot of milk that they source locally. So they said they're not as impacted by tariffs as other companies. They say commodity prices might go up, including milk. That's what they're looking at. So they are not going for broad-based pricing, but for selective pricing going forward. That's a comment that we hear from the CFO this morning. So here again, a stock that has been performing well because of the areas where they had been specializing on. So a stock that's up 23% over the past 12 months, but in the red this morning.
Just on that point around pricing, we've seen obviously obviously a very strong pricing cycle on the back of the COVID era for a lot of these corporates. What is Danone really talking about when it's talking about selective pricing? Is that it's saying, look, we're seeing some pressure from consumers now substituting. We can only price up in very select categories. Is that what they're talking about?
Yeah, so we've seen, as you're saying, consumers go towards a supermarket brand for a basic yogurt, for example. That's why they've been developing some of the different kind of products. That's why the protein, high protein-based products, they try to specialize, having the most science-based kind of product that they offer. That some of those other supermarket brands might not be offering. And of course, they're higher margin as well. So that's the kind of products they have been developing. And again, the whole push towards nutrition and gut health that is really having a moment now. They say yogurt is part of that. And they also make water. No, it is, and the growing use of GLP-1 drugs. The people that look after their health, they have a lot of yogurt.
And anyone else, you don't need processed products to have better gut health. In fact, quite the opposite.
But yogurt, a plain yogurt would be part of a good diet.
Greek yogurt.
But it's quite hard to remarket plain Greek yogurt every time, isn't it? It's one of the most natural products out there.
No, but the whole protein, a lot of people are taking more protein for the rebuilding of muscles, etc., etc. There's also one of the side effects of the GLP-1 drugs.
And again,
so that's why there's some of the products.
As it is in all of our households. Yeah. But the fact of the matter is, the purer the product, the less processed it is, arguably the better it is for you. Which is quite tough for these companies to say, oh, we're big in protein, when actually the most basic product, you know, milk, yogurt, unsweetened, is kind of
Well, they offer the specialized and the plain, I guess. That would be the argument.
It's always gimmicky. As someone once said to me, big broccoli doesn't have such a great lobbying as some of these others. Thank you very much indeed for that. The Chinese are kind of making the point I was trying to make throughout this show. There's a lot of Chinese Foreign Ministry comments here as well. And, you know, just the market rallied stunningly aggressively yesterday in the US and today in the futures, in partly because of the power stuff, but partly because they think that there's going to be a rapprochement with the Chinese. But the Chinese foreign minister's turning around saying, well, hang on a second. On the Trump comment regarding a trade deal, US can't say it wants to reach an agreement with China and, on the other hand, keep exerting extreme pressure. So, you know, this is the point. Where are the talks? Where is the rapprochement? Chinese foreign ministry adding, it's not the right way to deal with China and it's not feasible. Adding, US should conduct dialogue with China on the basis of equality and mutual benefit. Interesting to see how that tallies with the market expectations. I have noticed actually a lot of stocks out there you might expect to be rallying on hopes of rapprochement are declining today. For instance, Fresnio, silver miner, Endeavour Mining, there's a few stocks there you might have thought, oh, they might have rallied quite aggressively on hopes of a lessening of trade tensions, but there's an awful lot of stocks still across the board in Europe in negative territory. By and large, the premise is we're rallying, but the Chinese are making the very obvious point. You can say one thing, but while you're doing something else, how are we supposed to get to the table?
Well, the hard thing is that the Chinese may not be playing a straight line here either. In terms of Chinese tactics, they might be closer to a deal than we think, and there might be some element of pushback in the commentary. So we don't know what sort of game has been played by the Chinese.
True, and we always expect to get that from the Chinese Foreign Ministry, but I have seen nothing anywhere, and I do rely on not only CNBC, but other networks out there and other news organisations to tell us when there are high-level talks going on. I've seen nothing on any newswire in any publication that says that there are high-level talks going on between China and the United States.
I think we've got to assume, given how high the tariffs are, that there's some momentum to get something done at some point.
I disagree, Karen. I assume nothing when it comes to Trump.
Let's push on to the French numbers. French flash composite PMI fell to 47.3 points in April. The March final level was 48, so we are slipping below that in terms of this forward-looking survey. The forecast was for 47.8, so also underperforming that. On the services number, this is 46.8 points in April. In March, it was 47.9. So you can see the travel that we're making to the downside here. So some weakness and below forecast as well. On the manufacturing side, also in contraction at 48.2. That is down versus the March number, 48.5. And also, it is actually slightly above the forecast level. So the real weakness coming through in that services sector now, which is fascinating that is also now showing us some contraction.
Okay, we're going to take a very short break and take a look at the European equity markets into that break. So the German market leading the way higher with that very strong set of figures out of SAP. Although we are off our highs, as you can all see, across the board, giving back a couple of decimals, but so far still a very positive start to trading for European long positions.
live ambitiously.
You want to talk business? Meet me in the On Board Lounge. I just took a shower above the couch. You know why? Because this is the Emirates A380.
On the next Converge, meet rising next generation leaders shaping tomorrow today.
Keep on learning. Never be satisfied with just today's outcome.
It is our responsibility to adapt. However, I think it is also important not to compromise on your values.
Whatever decision we make as a company, we always keep in our mind, what good can this do for our country as well?
Doing good for business and society are not mutually exclusive.
Find out how they're redefining leadership on the next Converge.
It was a really good quarter.
This growth was driven by transactions.
Before they talked to Wall Street, they talked to John Ford and Morgan Brennan. Closing bell overtime.
Let's get another view. Rory McPherson is CIO at Wren Sterling and joins us now. Rory, is there anything in the last 24 hours that you've heard or seen that gives you confidence we're going to see less vicissitudes in policy making out of the administration and as such give you confidence to buy the equity market?
What we've seen in the last 24 hours is another reminder that the Trump administration does pay heed to the bond market. And as we saw the 10-year yield creeping up, we saw Scott Bessent come out yesterday talking about the prospect of a deal with China. We saw Trump come out as well talking about not wanting to fire Jay Powell. And I think that's reminiscent of what we had a couple of weeks back when you had the 10-year yield spike above 4.5 and you had Trump come out saying it's a great time to buy. So I do think that Trump does have a boss and it's the bond market. And I think that that kind of keeps a lid on where things are at the moment. And I do think there's excellent opportunities in markets as well. Perhaps not so much the US, but we might like markets like the UK, where you've got lots of boring stocks on good valuations that I think are starting to attract investor interest.
Love a good boring stock in the UK, but first of all, I'll ask you about the less boring stocks in the US. Why isn't this a great opportunity to pick up beaten up US stocks?
Look at the broad market as a whole. It's a bit cheaper. I mean, it's on about 19 times earnings now. That's not table thumping cheap. So, you know, we think if you own US stocks, it's not the time to sell them. But given the high levels of uncertainty around the administration, we don't think it's the right thing to be doing to be adding to these stocks at this point in time.
Rory, should we be worried that on a day that is upbeat, as markets are moving on the trade news, that the winners in Europe, the defensive names, are actually on the back foot, that they're sliding?
What we've seen in European markets is some of the defensive names, perhaps some of the mining stocks you mentioned earlier have come off a little bit, but I think that's reflective of what we're seeing is more of a risk-on market. Now, you know, the truth will be revealed, but we don't. What we're seeing now is we're seeing the more kind of risk-on cyclical names that would benefit from a rollback in tariffs and some sort of deal being done, perhaps with US and China, and just generally less broad brush tariffs across the board.
Rory, let me get into that because we've been shown somewhat of a horror film recently, these gigantic tariffs on China. But what Trump is saying now is that those tariffs will probably be lower, but they won't be zero. Is that still a worry, though? But just because we've been shown a horror film and then we're still just reverting back to some sort of scary film down the track, that there's still an impact for markets, there's still an impact economically. How do we think about the prospect of those some tariffs still remaining in place?
I mean, it's clearly not positive for economic growth if there's some tariffs in place, but if there's less than before, you're getting a relief rally in some of the names that were perhaps most hard hit. So, you look at some of the Asian exposed banks in the UK market rallying hard this morning. So I think if the tariffs are less bad than thought, then we can get back to the market or semblance of the market that we had before, and markets and the economy came into this in a reasonably strong position.
Rory, tell us about some of those boring UK stocks. I think our viewers probably don't see them as quite so boring, more exciting at the moment, in fact, that they aren't so volatile.
I think, we'd highlight sectors like consumer staples, sectors like utilities, even the banking sector in the UK, which has performed well, but still to us looks reasonably good value, trading on less than book value. And I suppose what we think we're seeing in the market is people wanting that margin of safety in the valuation. So you look at those types of sectors, they trade on cheap valuations. Even globally outside of the US, the earnings are not demanding in that part of the market. So you've got more of a buffer in the valuation. And I think we're seeing a little bit of the air coming out of the more richly valued markets and sectors, and a tilt back to those sorts of markets. And although the UK market has still been an outflow, I think some of the good performance can attract money in.
Rory, we've also got earnings rolling across Europe this morning. Big reaction from SAP, so getting somewhat of a discovery of stocks that are not being as impacted by the tariffs. How are you thinking about the price discovery in some of these stocks?
Within Europe, we tend to like more of the defensive and staples type plays. So less of the tech names like SAP. But really for us, we look at markets like the UK and Europe and broadly think that they're cheap versus the US, and that kind of comes through in the valuation. And yes, there's been a bit of a price uplift that we've seen this year in both of those markets, but we think that has quite a long way to run should we get some sort of calm return to markets. And I think we're starting to see that with the VIX dropping down a little bit, but it's still at quite elevated levels. So I think our message to our clients is that this is still a good time to be dripping money into markets and into your long-term strategies.
Rory, can I ask you about the impact of Jay Powell from here? Because clearly there was an impact as we talked about his future as to whether Trump will try and fire him. That seems to have settled down overnight. But this is a market where we still, I think, have huge question marks around interest rates, whether in fact we will get the 100 basis points of rate reductions this year, or whether it's going to be a very cautious approach from the Fed, because let's face it, these tariffs could bring some inflation. How are you thinking about the direction of interest rates and whether they could be market moving for the US markets?
So we think the best way to play interest rates is to be at the short end of the curve, where where you have less risk exposed to tariffs, broadly less risk to inflation that has pushed up some of the nominal bonds and has seen sort of 10-year and 30-year bond yields rise. As regards Jay Powell, it seems that Trump's lawyers have come back to him and perhaps said it's not so easy to remove him. So I think Powell has been very consistent and said that they'll respond to data, and that's the rock and the hard place that they're in that the hard data has broadly been pretty positive. It will start to roll over as some of the soft data catches up, but I think Powell has to respect the dual mandate that he's got and isn't going to be wanting to be cutting rates overly aggressively whilst the hard data is good. But I think as we've seen historically, if the economy does start to slow down, they will cut interest rates. So I think from an investor perspective, if you can be at the front end, you still pick up a very good yield. It's a little less than you're getting in 10-year bonds. But that's the bit that we think will be most susceptible to interest rate cuts and is where you'll protect yourself, but also pick up the return should we get the interest rate cuts that we think are coming.
Rory, thank you very much for joining us today on The Market Open. Rory McPherson with our CIO at Ren Sterling. Well, just ahead, we'll get the latest reading on the health of Europe's largest economy, with German PMIs crossing the wires.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box. CNBC.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Want to make some extra money, but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea. Get expert advice and hear real-life success stories.
Soon, you'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick, and these are your headlines. European equities open in the green, with Germany's DAX leading the continent sharply higher. S&P shares look set for their best days since 2019 after a first quarter operating profit beat. But CEO Christian Klein tells CNBC tariffs still cloud the outlook.
It's hard to say, it's hard to predict, but we remain optimistic given what we see in the market, what we hear from our customers. And look, at the end, this is what we can influence. That is what ACP can focus on, the success of our customers.
Donald Trump changes his tune on Jerome Powell, insisting he has no intention of firing the Fed chairman after all, calming concerns over the Fed's independence and prompting a big spike in U.S. futures.
The press runs away with things. No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates.
And Elon Musk says he will step back from his government work as Tesla's net income sinks by nearly 3/4 in the first quarter, as the company posts its biggest earnings miss in half a decade.
You just got to love what Trump says, doesn't he? It was all the press, by the way. He never said anything about Powell. Right, German HCOB April flash services coming in at 48.8 versus 50.9 in March, so slipping into correction territory by some margin from expansion. Flash manufacturing at 48 versus 48.3 in March, so a more constant figure there. But the fact of the matter is the HCOB flash composite figure, the combined figure, now in contraction territory at 49.7 as opposed to the expansion we saw of 51.3 in March. And there's a warning there for everyone who thinks that actually on the latest utterances from the administration that suddenly all the problems that have been created will just disappear. They won't. And as such, we're already seeing the ramifications of concern about trade wars and what it's done to confidence and what it's doing to investment as well.
Well, of course, we've seen the IMF pull back on forecasts for just about every nation on the planet. So what are we expecting? Zero growth in 2025 amid the uncertainty in the German economy. So I think what we had really magnified last week at the ECB as they cut interest rates was that we were talking about a demand shock in a lot of countries. And Germany is fascinating because it's also opened the spigots. It is spending money for the first time, but some of that fiscal package won't come through quickly. So there is a lag effect in terms of compensating for the tariff impact.
Yeah.
So the survey data is
and just to underline the oscillation we're getting from the administration, Trump says it was no intention of firing him. It was all the press running away with it. Last week, Donald Trump said Jerome Powell's termination cannot come fast enough. So let's not just be confused that there's an alternative truth out here. He said Jerome Powell's termination, not end of term, termination, cannot come fast enough. right? So let's not reinvent this as a mistake the press may have made or us just running away with it in some leftist agenda or something. The fact is, he said, his words, termination cannot come fast enough.
Well, those who are not tapped into financial markets might be saying, well, why are other central banks cutting and the Fed isn't now? But the reality is the self-harm we've seen inflicted by the United States means that there will be a direct impact on inflation thanks to the tariffs domestically. And if you've got high inflation, then you can simply not cut interest rates.
Or at least we don't know the ramifications, which is what Goolsbee said on this channel as well. It's what the other Fed members have said, is we just don't know how this is going to affect things. Look at the prices of Aston Martins in the United States, just one of the latest examples. Look at the prices that Mattel is going to have to put up. Look at the lobbying that the biggest grocers, including Walmart, have made to the US as well. So whilst at the moment eggs, oil, gasoline appear to be tame, when you start looking at the cost of manufactured goods that are seeing huge increase in tariffs, that has to have a direct ramifications on the people buying those goods and then passing that on to consumers. It's a fact. It's economics. And dare I say it, Elon Musk has pointed out that Mr. Navarro's thinking in no uncertain terms, might be slightly questionable.
The we don't know component is also driven by the Trump administration, the fact we don't know the timeline on these so-called negotiations, if that is what they are. We know some companies have stockpiled. We don't know how much they've been able to stockpile and for how long. And if these tariffs get lifted, what is the impact on all those goods that have been stockpiled, those simply that haven't been not
great story
put
that
into
is in the FT today that producer Dommy's just sent through. And again, same thing. Amazon and Walmart sellers hoard goods in Canada to wait out tariffs. Third-party vendors are betting the White House will back down. But in the meantime, they're hoarding goods. They pre-bought a lot of stuff because they're worried about the impact of tariffs.
Yes, so 1 quarter, 2 quarters, what are we talking about? And if some of their baseline tariffs remain, what is the impact of that on inflation? Let's push on to what the IMF said. A dramatic report. I think we've all looked at these reports over the last number of years, but this was a dramatic one. The IMF has slashed its global growth forecast for 2025, warning of a major negative shock from Trump's tariffs. The US was handed an almost 1 percentage point downgrade from January's forecasts, with the IMF also lowering growth expectations for other major economies, including the UK and China. Carolyn spoke to the IMF's chief economist in Washington and asked about the downgrade.
There is a huge amount of uncertainty in the global economy right now. So even for ourselves, in terms of figuring out where the global economy is going, we had to take a slightly different approach than we usually do. We basically established that reference forecast based on all the policy announcements up to April 4th. So that's after the Rose Garden announcement on April 2nd by the U.S. administration. And then we looked at the world based on this set of assumptions. And what we see is a fairly significant downward revision for growth in 2025 and 2026. We're seeing growth at 2.8% this year and going back to 3% next year. But overall, the cumulated downgrade is 0.8 percentage points. So that's quite significant.
Carolyn also asked European policymakers about the impact of US tariffs on the continent and the importance of clinching a deal.
The transatlantic partnership is strategic. It's very important for Europe. It's very important for the United States. It has provided prosperity and well-being on both sides of the Atlantic for the last 80 years. I think we should continue to try to build a peaceful, a prosperous, a strong partnership across the ocean.
I think that President Trump is on the deal side and that he wants a good deal, good for US, and it's obvious that we want a good deal for EU. A good deal for member states like Poland. So I do believe that we will find an agreement, and it's very important for markets. We see that markets are volatile. We see the dollar is getting weaker. Yields on U.S. treasuries are going higher, and this is not a classical risk-off scenario. So I do believe that it's in the best interest of everyone to find a good solution as soon as possible.
Let's get to Christoph Bosken, the CEO of Wiener Börse from AG. Let me get to you, Christoph, about the tariffs first up, because what we're hearing is that there's a potential for some sort of a breakthrough here with China, but we don't have any details, of course, just some signaling from the White House. How welcome would that be, given we've just had downgrades from the IMF on just about every country across the world?
Yeah, good morning. Look, I mean, the good thing for Europe is that it is currently not the main battle line in the tariff conflict. Actually, rather the contrary. It has a relative advantage because, well, we are starting in Europe, and that is decisive for the investors' audience. We are starting here from a very moderate valuation price earnings, still fluctuating in our market around 7, 8, maybe on the European average, it's 12 up to 13. So quite a gap to be closed, particularly to the US markets. And yeah, I mean, concerning the tariff conflict, mainly with China again, this is actually advantageous for you currently because our market, every good that is now lacking access to the US market will flood also into Europe. So this will have a deflationary effect too. And yeah, again, I think when you think about Europe and its role in the tariff conflict, then I do see a relative strength, a relative strength also because of the tremendous Keynesian firepower we still have in possession. Don't forget, the debt burden in relation to the overall GDP stays around 60 up to 80% in Europe, which is actually half of what it is in the US. And that altogether makes me quite positive, actually always relatively positive in relation to the rest of the world for Europe.
Can I ask you about the direct impact on your exchange, though? Because it feels as though we've seen very strong trading activity around stocks, at least. And the banks, US banks the other week actually magnified this when they reported their numbers. But other business has been taken away and put on hold, hasn't it? So just explain what you're seeing from the exchange's perspective.
Yeah, from a technical market operator, I can absolutely confirm that we've seen a drastic increase in volume, double, even tripled volume on some days. That's the usual volatility effect. But yes, admittedly, to an extent that we very rarely see on the exchange. And yeah, in terms of volatility, I mean, you all see the volatility that has been induced to the market. That will continue for the time being. And for market operators, actually, and this is not an investment advice, and Vienna Bourse is not listed, but other exchanges are. Maybe it is worthwhile looking at infrastructure providers like exchanges for investors too these days.
Christoph, very good to see you. You're not listed, and I was going to come to that because obviously you have some very esteemed shareholders from Erste to Unicredit, etc. Do you ever have that conversation with Stefan Bujnar where he puts an arm around your shoulder, Christoph, and says, come on, Christoph, come and join us?
Yes, absolutely. And I know the arm of Stefan very well. And I can only say what I have always said, exchanges need to merge. They have to merge if it makes sense. But again, look, I mean, our clients decide on a very daily basis about the value of the services that we provide here in terms of trading, in terms of data provision, index calculation, or our recent fledgling central European debt listing platform where we gained market leadership over the last 5 years. So obviously, the mere existence of very successful, rather small or mid-sized market like ours proves those advocates for further consolidation wrong. And you know what? I mean, we have a very, very cooperative partnership with Euronext, and I like the model, I like the strategy, and kudos to Stefan and the work he has done over the recent years. But what really bothers me is the role of European politicians these days. How lightly and easily they discuss the issue of consolidation. Because this is something we should definitely leave to the market. Again, our clients decide that question on a daily basis. And I can only urge European politicians really to abstain from going down that way of politically planned economy. That is the wrong path. They should rather do their homework in their genuine role as European politicians. Their obligation is to provide us with a stable, regulatory environment with a unified supervision, maybe, that then carries out the regulatory supervision on an equal footing and equally over all the union countries. So that would be my call to return to the genuine work politicians have to do and to leave the rest to the market forces.
Is he still a politician? I was thinking about Enrico Letta. Was a politician, now an academic, now an advisor, and his proposals plus Draghi's make me think that there are some great policy initiatives that could tear down the barriers, that could make it so much easier to raise capital in the magnificent city of Vienna and elsewhere in Austria as well, if only they take on board those proposals, Christoph.
Yeah, absolutely. You are referring to the so-called Capital Markets Union. The Capital Markets Union is one of the largest distractions. What the really need of the market is. Yes, I know the letter in the Draghi report very well. And if you really read through it, you just say, yeah, okay, all administrative measures that need to be taken. And please, dear politicians, go on with it. Yeah? There is no discussion about it. It's all right. It has our full support. But nothing of this, even combined and even summed up, will solve the fundamental problem of the European markets, and that is lack of relevant capital pools. This is the decisive measure. Yeah? Every political action should actually be targeted at setting up the relevant capital pools that then enable us to compete with the US, and everything else, the infrastructure, the investors' rate, the stability of the social security systems will then derive out of that.
Christoph, we've had the honour of speaking to so many of the key players in Austria over the years, looking not only, of course, to the west, but also to the centre and to the east of Europe and those great growth drivers that are the emerging nations as well. Are we going to get that kind of drive back in Europe that those countries represented and that Vienna and Austria so kind of helped capitalise? Is that coming back anytime soon? Do you think that drive, that energy?
Oh, it's not only coming back, it has actually never changed. And when I look at markets, I always just judge about the relative competitiveness of this or that region and this and that investment opportunity. And what remains to be the case is that growth in the Central and Eastern European region has been, is, and will be for the foreseeable future twice as high as in Western Europe. So the Austrian investment story, with a lot of attractive issues that are active in the Central and Eastern European region, that is still intact. And again, on a very, very moderate valuation, because it took a certain hit from the Ukraine crisis. But this is maybe then worthwhile to discuss at another point in time. When we will have peace, this is actually the region to invest, and it is the Austrian issues that will benefit the most from it.
I've loved it to see you, and I look forward to hopefully coming down to see you in Vienna at some stage soon. That'd be great. Christoph Boschan, who is the CEO of Wiener Börse AG. Thank you, sir. President Volodymyr Zelensky said Ukraine is ready for talks with Russia in any format once a ceasefire is set. Meanwhile, the Russian President Vladimir Putin has reportedly offered to halt the invasion at the current front lines, according to the FT. Diplomats from the UK, France, Germany, Ukraine and the US are holding talks in London today aimed at securing a ceasefire, although my understanding is that the US delegation has been pretty much downgraded, I'm afraid, to not having the Secretary of State, but I may be wrong on that. I hope I'm wrong. I don't think I am. The United States is proposing to unofficially recognize Russian-controlled areas in Ukraine, according to an Axios report. The plan, part of a peace framework that would see the US lift sanctions on Russia and a small part of Russian-occupied Kharkiv returned to the Ukraine, was presented last week. The US is expecting a response to the proposal today, which they have stated is President Trump's final offer. Spain has vowed to hit NATO's defence spending goal of 2% of GDP this year. Spanish Prime Minister Pedro Sanchez said the country would contribute to defending Europe as he brought forward Spain's previous self-imposed deadline of 2029. Charlotte, anyone who watched the show earlier would have known a very robust conversation we had about why the Spanish are so late to the party. Let me paraphrase that bit. There are historical issues with the military in Spain that goes back to the dictatorship from the 1930s all the way to 1981 that you and I discussed, and I remember, you're too young for that. But ever since 2006 in Riga, there has been a commitment, and Spain has unambiguously, they have signed up to the agreement, but they failed to deliver.
Yes, and look, when you look at the headline saying Spain will reach 2% of GDP to contribute to NATO, you'd think a bad time. But here again, there's a lot of context and why it is an important moment when the Spanish Prime Minister announced that he will meet this target this year, because there has been a laggard, like the worst contributor out of all NATO, just 1.4% of GDP last year. And again, historic reasons, politically, one of the reasons why none of the parties wanted to spend a lot of public money into the military is, of course, decades under a military dictatorship, a failed military coup in 1981. And of course, when Spain joined NATO in 1982, well, Spain was busy modernizing its economy and entering the European Union. Then you had austerity that hit after the financial crisis. A lot of reasons why Spain didn't spend so much, probably because, you know, they thought they just benefited from their security umbrella from the US and NATO, and so they didn't want to dedicate too much of their money to this. Of course, now, given the international context, there's a big change. We're 1 month ahead of the NATO leaders summit next month in The Hague, and this announcement from Pedro Sanchez talking about how the objective was to modernize the security and defense capabilities in Spain.
We're going to leave it there. Thank you very much indeed. Charlotte, talking, and if you don't know much about the Franco, it's certainly the latter years and the very complicated rebirth of democracy and the relationship with the crown as well. The former king, I mean, he's got a very checkered past, but he had such a pivotal role in bringing democracy back.
It was very touch and go for a long time, that transition.
I know. I mean, we look now at Spain, we say, oh, it's a liberal democracy. It was guaranteed. It wasn't guaranteed. No. Way after. When I was still jetting off with the family to Tenerife in the 70s, it was still a dictatorship.
Yeah, it's living memory in Spain.
Yeah.
That's why you're giving a lot of money and a lot of ammunition to the army. It wasn't something.
Coming up on the show, President Trump changes his tone on Fed Chair Jerome Powell, promising he has no plans to fire the central bank chief just days after calling him a major loser. There you go, more oscillation. More on this next.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
On a $100,000 margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
I was studying molecular biology, going to grad school. I started investing a little money for my dad, and I got bitten by the bug. I was a stockbroker, and it's fun, but we all wished we could just follow the markets and talk. And my ambition was to be able to pay my bills and not have to constantly be selling. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
The day's top stories driving Wall Street. Brian Sullivan joins Kelly Evans. Power Lunch, CNBC.
The string of green continues on European markets, encouraged by that stateside picture yesterday. They will bounce on the back of hopes that, look, there could be some sort of negotiation still between the US and China, given the context of these very high tariffs. So that signaling from the White House, very dramatic for US markets yesterday, and it's spreading across Europe today. So we've bounced 1.4% on the FTSE, the DAX even stronger, 2.5%. So we seemingly on these two boards at least are making a good effort at going back towards the highs in recent weeks. The French stock market that's been somewhat lagging thanks to the luxury space is also piling on close to 2%, and stocks out of Italy up close to 9/10. So a very strong session playing out in Europe today. US futures, can they back up some of those big gains from yesterday? It's also earnings season, don't forget. And what we're seeing across the chart suggests it will also be another very strong day. So we're looking at the S&P 500 signals close to 100 odd points. Very firm on the Dow, though. You can see 540 odd points to the upside, close to 400 on the NASDAQ. So we're looking across the board at a sweep firmer this morning.
What do you think of when I say the words thin gruel?
Porridge.
No, that's watery thick porridge. Gruel, isn't it?
No, watery porridge.
Yeah, it's kind of like, it's what you would give to prisoners in a Victorian jail or something, or it'd be in a Dickensian novel, wouldn't it? The thin gruel.
No protein, that's for sure.
No protein, no meat in it, nothing.
No nutrition.
No nutrition, whatever. And I think the market's rallying on thin gruel, I've got to be honest. It's pure hope that suddenly there are grown-ups, suddenly the bond market is putting guardrails. You know when you go bowling, and if you're a really rubbish bowler, they put the guardrails down, and you do it, and you end up in the gully either side. I mean, I'm sure there's a lot of very good bowlers out there. But when you put the guardrails up, you can't actually fail. Certainly not on the first bowl, anyway. You can't actually miss if you've got the guardrails up. Pretty much, or you've got to be pretty dismal to miss. And well, not seeing direct to bowl. Yes, he's pretty awful apparently.
So you're saying this is not a full English breakfast that we've been served this morning?
This is not a full English breakfast with fried bread, black pudding, big Lincolnshire sausage, you name it. The market's rallying. Yet last week the man's saying the termination can't come quickly enough. This week he's saying he's got no intention of firing Powell. Next week, what's he going to say? Is he going to? So would you honestly move your portfolio aggressively on the back of that? And then the other thing it's rallying on the back of is said, come on guys, this isn't going to last. 145% tariffs in China. Come on, this is the high water. They're going to be lower, but nowhere near where they are now. But they're not going to be zero. It's like the Chinese are saying, well, hang on, you're not talking to us. You're talking at us. And all right, don't get me wrong, there's culpability on both sides of the Pacific as well. But the market is rallying on hope. And as a great man once said, hope can kill a man. By the way, that was in Shawshank, so it wasn't actually a market phrase.
So you don't have to be a mathematician to know that there's going to be a slightly different impact from triple-digit increases on border taxes versus double-digit increases on border tariffs. So I think, if you get a slight retreat from these monster tariffs on China, that does make a difference. But then you've got to ask, what are we left with? And this was some of the questioning. We have been absolutely shocked by the extent of the tariffs. There is no doubt about it, and there's no form of substitution or no way some of these merchants can simply just wear some of those higher costs. But any negotiation here is going to make a difference. But what are we left with at the end of the day after we've had a fairly significant reset on the IMF forecast that these economies from the United States and beyond are going to be very much impacted?
It's happening now. The ramifications of these trade policies and these tariffs aren't something that can be just wiped out. It's happening now. We're living with the ramifications. And for the markets to be glib and say, we're okay now, because he's got guardrails. It's just nonsense.
It's a trading market, though, isn't it? It's a very dynamic trading market.
But the problem is we don't know whether it's trading policy or real policy that's going to last one administration, two administrations, and thereafter. We just don't know. Anyway, that's it for Squawk Box. We'll be back same time, same place tomorrow. Up next, Juliana Tattlebaum and Street Science.
I took my first journalism class in high school. It felt like a superpower. I find it really meaningful to reach new audiences, women, people of color, younger demographics. A lot of traditional financial advice might not take into consideration that people have debt or that rent is so expensive. To me, ambition means taking on new opportunities that take you out of your comfort zone, but help you learn and grow.
Wow, that's exciting. People are not afraid to relax. Oh my God. So this is my family's go-to spot, and it's always so good. My name is Chad Kubanoff. I've been living in Ho Chi Minh City for close to a decade now. This really is like the steak and eggs in Vietnam. I love Vietnamese cuisine because it like crosses lines all the time. Like, is this a salad? Is this a noodle bowl? It's somewhere in between, and I think that's really exciting when you see dishes like that. I was reluctant to show you this spot because I love it so much and I don't want it to get any busier. And it's so cool in Ho Chi Minh City because there's so many different styles of coffee shops, so no matter what you're into, there's something for you. If you want something that's a little more chilled, there's absolutely that. Or you want something that has a lot of koi fish, they have that as well. We can't be in Saigon without talking about Cơm Tam or broken rice, which is like the dish of this city. After 10 years of living here, my palate has completely changed as a cook and as an eater. I love this kind of eating. This is what made me fall in love with Vietnam. Welcome to my neighborhood. Let me show you a few spots I love to go to in my downtime.
It's a new science that could disrupt the medical industry.
The project is to understand the genetic makeup of Asians and to find out which of those genetic markers are ethical markers and not disease markers.
We're taking the bone marrow cells from the patient, making the edit, and we're putting it back into the patient, making a drug just for you.
I think that this technology is going to totally reshape how people have children.
The Edge dives into the world of genomics.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fell for them.
I believe in getting justice.
American Greed on CNBC.
CNBC is on assignment in Barcelona as Spain once again plays host to the Mobile World Congress.
We have all this kind of wildfires everywhere. You know, there is the need for data centers, there is the need for more computation power, there is this need for AI, there is the need for connecting the world to bring businesses together, there is the need for consumers to have faster access. And for all of this, you know, we are kind of firefighters trying to solve that problem, but we have a leaking hose here in Europe, because the regulatory environment is not fitting.
I think it has created a different thinking. The momentum's still there. Large language model continue to be prevalent.
AI is such a compelling technology. Every country in the world is going to pursue it. I think it's an imperative that the Western world lead in innovating in this new technology. That means investing in compute so we have the best infrastructure. It means investing in data so that the models can be trained in innovative ways.
Good morning and welcome to Street Signs. I'm Juliana Tattlebaum and these are your headlines this morning. SAP shares look set for their best day since 2019 after posting a first quarter operating profit beat. But CEO Christian Klein tells CNBC tariff clouds the outlook.
It's hard to say, it's hard to predict, but we remain optimistic given what we see in the market, what we hear from our customers. And look, at the end, this is what we can influence. That is what SAP can focus on, the success of our customers.
Donald Trump changes his tune on Jerome Powell, insisting he has no intention of firing the Fed chairman after all, calming concerns after the Fed's independence and prompting a spike in U.S. futures.
The press runs away with things. No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates.
Elon Musk says he will step back from his government work as Tesla's net income sinks by nearly 3/4 in the first quarter as the company posts its biggest earnings miss in half a decade. And BP lines up its biggest share price move in more than 2 months, surging on the back of a Financial Times report that Elliott has upped its stake. A very warm welcome to Street Signs. Let's kick off the show with the latest out of SAP. The German software giant beat earnings expectations in the first quarter despite cloud revenue coming in shy of estimates. Adjusted operating profit rose 58% in constant currencies to 2.5 billion euros. SAP, wow, we've been open for just over an hour and the stock is up more than 9%. Let's get out to Annetta, who has more on what's driving SAP higher this morning. Annetta.
Well, good morning. Yes, it was a very positive surprise that SAP is also showing a huge cost discipline. That is actually the reason for this very much improved margin. The EBIT margin now is standing at 27.1%. Also, in general, the message that the clients are not walking away from their software solutions, but to the contrary, actually demanding more to save costs and to implement cost-saving programs is a very positive signs for investors. And there are even some analysts saying that the guidance or sticking to the guidance is rather prudent than optimistic. Earlier on Squawk, we spoke to Christian Klein, and he explained to us that 86% of their revenue is actually predictable. Let's listen in.
When I talk about predictability, it's not only a buzzword. I mean, look at our total revenue. It actually consists of 86% recurring revenue. That is predictability. That is resiliency. And I was just, last week in the United States, talked to many customers, and of course they got hit by tariffs. But what they are telling me is, Christian, your software is now more relevant than ever. Why? Help us to manage tariffs in over 130 countries. We are doing business everywhere. Help us to make my supply chain more resilient, which suppliers can still deliver at the costs which I need to still produce my goods at a competitive level. And that, Steve, gives me and the company a lot of confidence also in these times when it comes, for the development, for the whole year. And that's why we also confirmed our guidance.
So the shares were down roughly 9% until today, and that, of course, has been leveled out now, and the outlook seems to be intact as well. So what SAP is saying that they are not affected by tariffs, and even though some of their customers are, like in the automotive space, they really rely heavily on those SAP solutions, talking about as well managing supply chains, their new products coming in from SAP, which enables clients to manage their supply chains based on AI solutions. The CFO said in the call early on today that only a little fraction of the business, which we probably almost all know, which is Ariba, Concur, and also FieldPass, might be affected by macro uncertainties, but this is only accounting for 14% of their overall revenue. So bottom line is the free cash flow also has increased by more than 30%. Or roughly 30%. That gives them a buffer as well to be able to navigate through that very uncertain macro environment. And at the same time, it seems that they kind of have an infrastructure business because, as Christian Klein was just saying, 86% of their revenue is really predictable and not affected by macro uncertainties, Juliana.
Annetta, really appreciate the context there behind this 9% move for SAP. Let's broaden it out and take a look at European markets more generally. Yes, we are seeing an exceptional move higher for SAP, but we're seeing a move higher across the board in Europe, catching up to yesterday's strong trade on Wall Street. The European markets had closed up before the bumper session really kicked in the afternoon yesterday after some comments from Treasury Secretary Scott Bessent in a closed-door meeting suggesting that we could see a de-escalation in trade tensions between the U.S. and China. That seemed to be what really got the market moving. And then after markets closed, the positive momentum continued with some more encouraging comments from President Trump himself. So we've got the Xetra DAX up 2.6% right now, the CAC 40 up more than 2%, FTSE 100 also up about 1.5%, and the FTSE MIB in Italy lagging but still up about 1%. Breaking it down by sector, here's the split in Europe. You've got basic resources out in front, up about 3.6%, perhaps tied to the comments or the suggestion that we could see a de-escalation in U.S.-China trade relations. Technology also getting a boost, up 3.4% or so yesterday. All of the Mag 7 in the U.S. advanced by at least 2%. So the European tech names joining that rally. The banks up 2.4%, travel and leisure also doing well. So quite a cyclical slant to trade. On the downside, the laggards in the market, we've got utilities, the only sector in the red, perhaps the most defensive part of the European market, down 0.3%. Otherwise, it is all systems go. Real estate, telcos, insurance round out the laggards, but still in positive territory. Now on to U.S. futures. Where do things stand today? Well, we've got the Dow Jones looking to add another 580 points, the NASDAQ looking to gain another 400 points, and the S&P also looking to rally further. Again, this is after President Trump's positive comments after the close around no intention of firing Fed Chair Jerome Powell, so that seems to be easing nerves as well. On that note, this is specifically what he said. He's not planning to fire the Fed Chair Jerome Powell. His latest remarks come just days after lashing out at the central bank chief, describing him as a, quote, major loser, and writing on social media that Powell's termination cannot come fast enough. Speaking to reporters after a ceremony to swear in Paul Atkins as chairman of the U.S. Securities and Exchange Commission, Trump explained his decision.
The press runs away with things. No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not, but it would be good timing.
Our U.S. colleague spoke to ECB President Christine Lagarde, who gave her take on the central bank's policy diversion with the Fed.
We have inflation coming down seriously. As I said, last reading 2.2%. Our projection for 25 is likely to be 2.1%. Inflation expectations are very anchored around the 2%, including in the medium term. And we have growth, which is projected to be 0.98%, depending on whose projections you're looking at. The U.S. is a different situation, and the impact of tariffs will be different on the two economies.
Well, we just got some fresh data out of the Eurozone moments ago. The composite PMI for the bloc narrowly remained in expansion territory in April at 50.1. That was below economists' expectations for a 50.9 print and well down on the month previous. That was driven by weaker than forecast services sector data, which made a surprise fall into contraction territory at 49.7. National PMI figures released earlier this morning showed a similar picture as the German and French economies missed expectations, also driven by weaker than forecast data for the services sector. Let's take up the conversation on what's happening in Europe with Tomáš Viladek, Chief European Economist at T. Rowe Price. Tomáš, thank you so much for being with us. Let me kick off with the survey data we just got in from the Eurozone. These are the latest PMIs, and what strikes me is that this data covers the April period, and whilst these are just flash figures, so far the Eurozone seems to be holding up just fine after the April 2nd announcement. Doesn't seem like we're seeing any major change in business activity, but perhaps that's because we're seeing some front loading. What's your sense of what's going on?
Yeah, I think there's a general recovery in the manufacturing sector. Part of that is certainly front loading, and I think that's one of the reasons why you see this divergence between manufacturing and services. Manufacturing clearly still doing very well. I think much better than many of the more bearish analysts would have expected. Services, you see that there's clearly a confidence impact, and I would argue that services is what really matters for the ECB, because that's the indicator that's still mostly correlated with the overall GDP. It's also the largest share of the economy, so therefore the ECB will probably be more paying attention more to those weaker services figures.
And given the importance of services, the outsized importance, what could restore confidence, and what is your sort of prediction for how services activity evolves from here?
I think in the short term it's challenging to see what can restore confidence other than these trade conflicts going away completely, which is probably unlikely. In the medium term, what needs to happen is this big German fiscal package that was passed just 2 months ago, it really needs to come online. The Germans really need to sort of step on it and use the monies they have for public sector infrastructure improvement, really use them productively, and I think that is what can drive the service sector of the European economy going forward.
How quickly do you think Germany is actually going to be able to deliver? I mean, and what is your assessment of how much execution risk there is with Germany's spending package? Because it feels like a lot of investors are piling into this trade when it comes to markets here, but what's your take from an economics perspective?
So Germany and the EU, they always have some implementation issues.
Right.
There's planning challenges and so forth. However, this government, I think for the first time in a very long time, in decades, has shown that they're willing to act. So let's hope that this new German government continues to be willing to act and they get the groove on when it comes to fiscal policy.
When is it going to start showing up in the data? And I mean, you talk about today's PMIs and the manufacturing sector probably holding up because we're seeing some front loading, not the case with services. When is that front loading going to stop, and are we going to then see the defense spending sort of take over and offset the negative hit from tariffs that we're likely to see in manufacturing?
So I think on the manufacturing side there'll probably be a pause for some time, because the front loading is going to stop. At the same time, because the tariffs on China are so high, competition with Chinese goods, of European goods on third market is going to really intensify. It's going to make it very challenging for European goods producers to stay competitive going forward. And the defense spending, it's probably going to come online at the earliest in 9 to 12 months' time. So, maybe the next month or so, manufacturing will still be all right. Then it'll probably weaken. And then there'll be a recovery sometime next year.
Can you flesh out a little bit more the impact that you expect to see from Chinese goods flooding the market, and how much of that we're going to see in Europe?
So I think this could be quite a lot, and in the sense that, you could describe the current China-US situation as an embargo. And clearly, I think there's probably already some trade diversion towards Europe. What it basically means is that the prices of Chinese manufacturers' goods are going to fall significantly. It's very unlikely that the European Commission will be able to, in time, raise tariffs on Chinese goods to offset that. But perhaps the largest impact is on third markets in Asia, Africa, and Latin America, where Chinese goods will become very, very competitive. And unfortunately, that's not the case for German goods, especially because the euro has been appreciating so much.
What does this all mean for the European Central Bank?
So I think what it means for them is clearly manufacturing still holding up, but services going weaker. That is the major part of the economy. It is also where inflation is sort of coming from there, so they have disinflation. I think they can easily cut to 150, perhaps lower, depending on where this pans out. But then after that, there will be a pause in rates, maybe at 150 for a while. And then in 2026, I think they'll hike again as the fiscal comes online. So it's really a U-shape for interest rates.
So already in 2026, you see them raising again?
Yeah, probably late 2026, because I think the incentives for the German government to really step on the fiscal accelerator, put the pedal to the metal, so to speak, are pretty strong at this stage.
That's an incredible pace with which we may see policy move. What does this all mean for the euro in your view? I think this has been one of the biggest surprises of the year, is the trade higher we've seen in euro versus the dollar. And obviously a lot of that's been driven by what's happening in the U.S., but how does that factor into the European picture?
I think over the next 6 months, the euro will probably go a bit lower, especially as the ECB will likely continue to cut. The Fed may actually cut less than expected now that the political pressure on Powell is a bit off. It's not as strong as it was anymore. Not that that matters, but still. And so that the euro will probably go down initially. And then in the medium term, it'll probably go up a little bit again as the ECB starts hiking again in the latter half of 2026.
I was just thinking over the weekend how Germany has, for years they were criticized for being too focused on austerity, and their commitment to the debt brake was, outdated. But here we are in a situation where effectively, thanks to Germany's fiscal austerity, they're in a position to almost bail out Europe again. This has been, this is the big driver of investment coming into Europe, this massive fiscal plan from Germany. So the Germans must feel pretty vindicated right now, I would imagine.
Well, I think they're learning from their mistakes. I think what they've learned is that austerity, especially if it's in such a major economy, doesn't really work. And that perhaps the target, so having debt to GDP so low relative to everybody else, there's probably some room to spend, especially because even with this huge package, right now the debt to GDP is 60%, maybe they'll end up at 70 or something like that. They'll still be way lower than everybody else. So I think they learned a little bit to relax a bit about the fiscal stuff and to basically use fiscal policy to propel economic growth and generate some domestic demand. I think, it's probably the first time we may see in several decades that there might be a different European business cycle. Not always dependent on just US growth, but actually having an independent domestic growth driver for Europe.
It'll be an incredibly different picture to what we've seen for the last several decades.
That's right.
Well, perhaps I've been too generous with my take on how Germany's probably feeling right now. Tomasz, thank you so much for sharing your views. Tomasz Wielodek, Chief European Economist from T. Rowe Price. Let's get you a look at U.S. markets and how we closed up yesterday. The bumper session really kicked into high gear in the afternoon. So after European markets closed, we ultimately ended with the Dow Jones up over 1,000 points. The S&P gained 2.5% and the tech-heavy Nasdaq gained 2.7%. As mentioned, all of the Mag 7 gained at least 2% in yesterday's trade. Now, Tuesday's market turnaround came after President Trump talked up relations with China, signaling that tariffs will drop substantially.
145% is very high, and it won't be that high. It's not going to be that high. It'll come down substantially, but it won't be zero. It used to be zero. We were just destroyed. China was taking us for a ride, and just not going to happen. It's not going to happen. We're going to be very good to China, have a great relationship with President Xi.
The rally was also triggered in part by remarks that U.S. Treasury Secretary Scott Bessent reportedly made at a closed-door event hosted by J.P. Morgan Chase, where he said that the tariff standoff with China cannot be sustained, and he expects the situation to de-escalate. That's what really got the markets going yesterday. Now, UK Chancellor of the Exchequer, Rachel Reeves, is set to meet U.S. Treasury Secretary Scott Bessent at the IMF's spring gathering this week in a bid to secure a trade deal, after the IMF warned the UK is set to be one of the hardest hit by the Trump tariff regime. Speaking before her departure, Reeves said the world has changed and that we need a world economy that provides stability and fairness for businesses. The U.S., meanwhile, is reportedly preparing terms for any deal talks. That's according to the Wall Street Journal, which says the country is eyeing a cut in the U.K.'s automotive tariff to 2.5% from 10%. Washington is reportedly also looking for the U.K. to relax its rules on agricultural imports. This, as Politico reports, British officials are trying to bring down the 25% tariffs on metals and cars imposed by Trump and have offered to rethink the country's digital services tax. UK government borrowing exceeded expectations in March. Excluding banks, net borrowing totaled £16.4 billion for the month, ahead of the £16 billion the economics community had forecast, with total borrowing for the fiscal year ahead of the Office for Budget Responsibility's March projection. Coming up on the show, Elon Musk says he will step back from his government work as Tesla's net income sinks. We'll have the details after the break.
I like waking up in the morning and feel like I've affected lives, where we want to make Web3 and crypto and blockchain more accessible to the masses. My name is Wei. I'm the co-founder of Failsafe. Failsafe came about from a very internal use case. We were running a consumer retail business and our users kept getting hacked. So we started building a suite of products to protect our own customers. I got funding to move to the Valley to do my own startup. Got a call from the Grab co-founders, and they convinced me on one thesis. As someone born and bred in Southeast Asia, wouldn't you want to see the region thrive? The transparent regulatory framework in Singapore, as well as the ability to leverage on the trust brand of Singapore, has accelerated people doing business, and that's why we chose Singapore.
Journalism was always the perfect career for me. I've always been an egghead and a nerd. When I'm covering tech, my job is to really take these wonky and complicated topics and distill them down so anyone can understand. Ambition definitely fuels the tech industry. There's still this air of possibility when a new tech product comes out, that it can do anything, that can change the world. There's nothing better than breaking news, jumping on camera and telling everyone immediately what they need to know. I love what I do. No day is the same. I couldn't imagine doing anything else.
Live from the New York Stock Exchange, Halftime Report, CNBC.
Welcome back to the program. Elon Musk says he will pull back from his work with the Trump administration after Tesla posted its biggest revenue and earnings misses in half a decade. Net income at the automaker sank by nearly 3/4 on the year, coming in at just over $400 million in Q1. That's a $1 billion drop. Meanwhile, revenue came in at $19.3 billion, nearly $2 billion below expectations. In better news for the firm, gross margin ex regulatory credits came in higher than expected, but the figure is still at a multi-year low. But it was Musk's announcement that he will be pulling back from government work that moved shares in extended trade, pushing them sharply higher. You can see there the stock up nearly 7% after hours. On the call, Musk gave his take on the Trump administration's tariffs.
Tariffs are still tough on a company when margins are still low, but we do have localized supply chains in North America, Europe, and China. So that puts us in a stronger position than any of our competitors. I'll continue to advocate for lower tariffs rather than higher tariffs, but that's all I can do.
Volvo Truck has cut its full-year forecast for the American market after net sales fell 7% in the first quarter. The Swedish truck maker is facing Donald Trump's blanket 25% tariff on all auto imports to the U.S., but CEO Martin Lundstedt said it is too early to assess the full implications of the tariffs. Reckitt Benckiser missed expectations on first quarter like-for-like net sales amid lower demand in Europe and North America. The consumer goods company, which makes medicines and cleaning products, among other offerings, maintained its full-year outlook, expecting sales growth between 2% and 4%. You can see Reckitt shares off nearly 5% this morning. Meanwhile, French consumer giant Danone beat expectations in the first quarter, with sales rising 4.3% on the year. The shares holding up okay this morning, up about 0.7%. And Charlotte joins us now with more on these numbers. Charlotte, Danone seems to be benefiting from this trend that we're seeing across consumers opting for healthier options. Give us a little bit more color on how they're capitalizing on these trends.
Yes, that's certainly the segment where they've been positioning themselves. The CEO talking about health through food, and that's how he qualifies his company. So these numbers better than expected. However, the beat was pricing driven. Prices were up 2.4%, but there was still a positive volume mix growth. And here again, some of these brands have been trying to get back some of the consumers. Have been switching some of the cheaper supermarket brands. So a growing volume was one of the key targets from the CEO, Monsieur de Saint-Afrique. And so that's something that they've been working on. Looking at different regions, they had a strong performance in China. North Asia sales up 9.9% like-for-like. The infant milk formula has been gaining market share. Looking at North America, up 3.7%. They saw a solid growth in their high protein product. And here again, it's a segment that they have been focusing on. Some of the high margin and higher price tag as well with the protein. And they said the GLP-1 products and more consumers using this kind of products make them buy more yogurt, and we know there's big focus on gut health, and also more protein, high protein products because of some of the muscle loss that they can suffer. So they've been positioning themselves on that segment as well. So another area that they've been focusing on for growth is specialized nutrition. They make some food designed for cancer patients and the elderly. They say, a lot of the biggest economies in the world see aging population, so they see this also as a segment where they're growing, and that division was up 5.3% there as well. So interesting also to hear the comments on tariffs, because they say they rely on milk and they source the milk locally. So they say in terms of tariffs, they don't see a huge impact directly. Of course, there is broader inflation might be impacting them demand for some of these products, like the high protein ones that are more expensive. But for the moment, they said no direct impact. They're not going for broad-based pricing, but selective pricing going forward, according to the CFO this morning. So here again, because of the strategy and the positioning that they had around health, around gut health, and water and yogurt, two products are in their portfolio. They've been doing better than some of their competitors. Their shares are up more than 23% over the past 12 months. So if you compare to Nestle, that is down 8%. From some of their own issues, but here again, because of their portfolio, they have been one of the winners of the current climate.
And that makes so much sense. And I know Nestle's been trying to engage in major portfolio shift for several years now to get out of some of those, confectionery traditional markets, which are just not in vogue anymore. Just let me pick up on your first comment around pricing, that this has driven a lot of the beat today. Given that we are heading into a more economically challenging period, their focus has been on trying to win back share from consumers who've been trading down.
Yeah.
Surely that could be a headwind moving forward, just ending up in the same predicament again.
Yeah, and that is the thing that investors are looking at closely. To say at the moment no change, but again the volume mix growth is something that they've been working aggressively on because they lost so much market share to cheaper brands. So at the moment it's still positive, but look, they reconfirmed their outlook for this year. They see they reiterated the fully forecast of like-for-like sales growth of between 3 and 5% this year. So we'll have to wait and see whether they start seeing an impact, particularly if we see inflation coming back because of tariffs in the US market in particular. Then they could see consumers trading down again, and that's something they'll be watching very closely.
Super interesting stuff, especially to hear more about what they're doing in terms of their specialty products and their specialty portfolios. Charlotte, thanks for breaking it down for us. BE Semiconductor posted a more than 8% rise in orders in the first quarter, boosted by demand in Asia. Revenue fell 6% in the period, and the Dutch chip-making parts supplier said it expects sales to remain steady in the second quarter. AkzoNobel posted core profit of 357 million euros in the first quarter. That was down 1% on the year, but ahead of analyst expectations. The company says it has compensated for softer markets with efficiency measures and that it has largely protected itself against direct tariff impacts. AkzoNobel shares getting rewarded for that, up nearly 7% this morning. Vopak posted a narrow beat in the first quarter, with EBITDA rising 0.7% to 300 million euros. The Dutch tank storage group also confirmed it has received conditional approval for the IPO of its Indian joint venture. BP shares are trading higher, set for their biggest daily move since February. It comes after activist investor Elliott reportedly urged BP to cut spending and increase its free cash flow by a further 40%. That's according to the Financial Times and Reuters. Elliott is said to have upped its stake in the company to more than 5% and argued that the reset outlined in February does not go far enough. Coming up on the show, the IMF slashed its global growth forecast this year, citing a major negative shock from Trump's tariffs. We'll have more after the break.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart.
Squawk Box, weekdays.
Master the art of salary negotiation.
Everybody who walks into a salary negotiation is nervous.
Salary negotiations are really awkward.
The number one soft skill is flexibility,
preparation,
confidence.
Learn how to negotiate a higher salary with CNBC Make It's new online course.
I'm going to give you a roadmap for doing the hard work.
Because ultimately, if you don't fight for yourself, nobody else will.
Register right now at cnbcmakeit.com/salary.
Access Middle East isn't just another finance show.
If you think about the UAE's trajectory, we actually think very, very long term.
It's a deep dive into the region's shifting power dynamics. What's different about Trump 2.0, particularly for the Middle East? Ambitious economic drive and the personalities pulling the strings.
Tariffs, trade wars, for whatever word you want to use. I think these are all challenging, not just for China, I think for the world.
Join me, Dan Murphy, for Access Middle East, your edge in Middle East markets.
Welcome back to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. SAP shares look set for their best day since 2019 after posting a first quarter operating profit beat. But CEO Christian Klein tells CNBC tariffs cloud the outlook.
It's hard to say, it's hard to predict, but we remain optimistic given what we see in the market, what we hear from our customers. And look, at the end, this is what we can influence. That is what SAP can focus on, the success of our customers.
Donald Trump changes his tune on Jerome Powell, insisting he has no intention of firing the Fed chairman after all, calming concerns over the Fed's independence and prompting a spike in U.S. futures.
The press runs away with things. No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates.
Elon Musk says he will step back from his government work as Tesla's net income sinks by nearly 3/4 in Q1 as the company posts its biggest earnings miss in half a decade. And BP lines up its biggest share price move in more than 2 months, surging on the back of a Financial Times report that Elliott has upped its stake. We've got some fresh data crossing the wires just now. These are the UK flash PMIs, and they paint a pretty downbeat picture of the UK economy. Company activity weakening by the most in more than 2 years as the U.S. trade war rages on. The composite PMIs come in at 48.2. That is down from 51.5 in March. So we've gone into contraction territory at the composite level. Manufacturing, 44, down from 44.9 in March. Here is the big kicker. The services PMI, 48.9 versus 52.5 in March. Very interesting. We just had a conversation with the chief European economist at T. Rowe Price, who said the real worry for Europe, and it seems like the UK as well, is the services sector, given its outsized importance for the overall economy here in the UK and in the Eurozone. And that's where confidence is really showing up here. Weak confidence. So we are looking at the lowest reading for the composite PMI since November 2022. Export orders have fallen at the fastest pace since the early months of the COVID-19 pandemic, while costs faced by businesses grew at the fastest rate in more than 2 years. Now, this is specific to the higher employment taxes and the increase in the minimum wage. These two measures have kicked in April, so that's underpinning the weak data here and the higher costs that are showing up in the UK numbers. The collapse in confidence and the drop in output during April raise red flags as to the near-term economic outlook and add pressure on the Bank of England to reduce interest rates again at its May meeting. That's according to the survey provider. One last comment here from the survey provider. There will be some uncertainty as to whether the recent upturn in price pressures could become entrenched or whether it merely represents a short-term tax-related spike, which should be looked through. So that remains to be seen. But overall, this is some weak data right now. Sterling trading down by about 0.3% versus the dollar 132.95. The IMF has slashed its global growth forecast for 2025, warning of a major negative shock from Trump's tariffs. The U.S. was handed an almost 1 percentage point downgrade from January's forecast, with the IMF also lowering growth expectations for other major economies, including the UK and China. Carolyn spoke to the IMF's chief economist in Washington and asked about the downgrade.
There is a huge amount of uncertainty in the global economy right now. So even for ourselves, in terms of figuring out where the global economy is going, we had to take a slightly different approach than we usually do. We basically established that reference forecast based on all the policy announcements up to April 4th. So that's after the Rose Garden announcement on April 2nd by the U.S. administration. And then we looked at the world based on this set of assumptions. And what we see is a fairly significant downward revision for growth in 2025 and 2026. We're seeing growth at 2.8% this year and going back to 3% next year. But overall, the cumulated downgrade is 0.8 percentage points. So that's quite significant.
In terms of market action in Europe, we are tracking the move higher we saw on Wall Street yesterday. All of the major bourses trading firmly in positive territory. The DAX is out in front, up 2.9% this morning, driven in large part by those bumper numbers out of SAP, the stock up more than 9%. In terms of the sectors, here's the breakdown. Out in front, you got basic resources up nearly 4%, so really strong swing there. It is all the cyclical sectors, though, that are seeing the strongest trade this morning. Banks up 2.7%, travel and leisure gaining 2.5%, technology as well up 3.6% or so after the Mag 7 advanced by at least 2% each yesterday. In terms of the sector laggards, here's where things stand. You've got utilities down 0.4%, otherwise every sector in the green. Now, in terms of those big names yesterday moving higher, yesterday we saw significant moves higher in a number of the major, the large tech names, and now this morning we are seeing the mega caps move higher in extended trade. Apple, Microsoft, Amazon, Meta, all poised to open higher yet again today. So those comments from President Trump after the market closed around no intention of firing Fed Chair Powell, paired with Treasury Secretary Bessent's comments earlier in the day in that private event, seem to be coming together to provide a lot of optimism to investors this morning. Relief, anyway. Now on to the geopolitics. President Vladimir Zelensky of Ukraine said Ukraine is ready for talks with Russia in any format once a ceasefire is set. Meanwhile, Russian President Vladimir Putin has reportedly offered to halt the invasion at the current front lines, according to the Financial Times. The United States is proposing to unofficially recognize Russian-controlled areas in Ukraine, according to an Axios report. The plan, part of a peace framework that would see the U.S. lift sanctions on Russia and a small part of Russian-occupied Kharkiv return to Ukraine, was presented last week. The U.S. is expecting a response to the proposal today, which they have stated is President Trump's final offer. U.S. President Trump has threatened secondary tariffs on buyers of Russian oil if no ceasefire deal is reached. Sergei Vakulenko, senior fellow at Carnegie Russia Eurasia Center and former head of strategy at Gazprom Neft, joins us now. Sergei, thanks so much for being with us. I'm really keen to hear your perspective on things. Let me just kick off with where oil is trading right now. We're back above $60, but we were hovering around that $60 mark a short while ago. What does $60 oil mean for the Russian economy here?
Cheaper than that, well, close to that number in India and China, but when the prices are not backed to the Baltic and Black Sea ports, it's $8 to $10 less. And that's stiff because Russian budget has been put together with an assumption of $69.70 a barrel for Urals sold at Russian ports. That was an aggressive assumption. Probably the state financiers realized that price might be closer to 60 for a barrel of Urals, but it's $10 below than that at the moment. So Russia would have to do some hard work with its budget, might have to curtail some civil expenditure, but it's definitely not anywhere close to the point where it would have to curtail its military expenditure. So this does sound as a bit of hardship for the economy, but not yet at the level where it would influence the military spending.
What level would that be? What level would force Russia's hand into curtailing its military expenditure?
It's a good question. Russia spends on war at the moment roughly what it earns for oil and gas exports, oil predominantly these days. Every $10 a barrel drop in the oil price translates into $25 billion per annum for the losses for the budget, or 20 to 25. Probably President Putin and his government would start to translate and send the hardship towards the population before they would start to cut military levels. So I wouldn't expect substantial cuts into military spending until the oil price reaches, say, $40 a barrel for a sustained period of time.
Okay, very clear. So we're still obviously a ways off of that. Let me ask you about President Trump's threat of secondary tariffs. He put this out there. We haven't had much of an update in the last couple of weeks on this threat, but he's put it out there that he's considering secondary tariffs on countries that buy oil from Russia if Russia were to stand in the way and obstruct a peace deal with Ukraine. If we were to see these secondary tariffs come into effect, what would this mean for Russia's oil industry?
It's an interesting foreign policy tool. It has already been introduced against Venezuela, but with Venezuela, it's much easier. It's a small supplier of oil. It sells its oil to a handful of countries outside India and China to some others as well that used to have general licenses before. And the world could easily do without Venezuelan oil. Russia is a very different case. It's a major supplier of oil and gas. If Russian oil isn't being oil and oil products and not being sold in the world markets, it would mean a shortage. So the buyers of Russian oil would be facing a tough choice between getting into trouble with the United States or paying over paying a huge price for their oil purchases or buying oil from Russia. Also, main buyers of Russian oil at the moment are India and China. And it's a very circuitous way to send its message to Russian government. You're not punishing Russian government. You're not punishing a seller of Russian oil. You're not even punishing the company that buys Russian oil, but the nation as a whole that company belongs to. And in the case of China, piling up those additional sanctions and tariffs, whatever they might be, 500%, as the current proposal states in legislation draft in Congress, wouldn't mean much. Currently, the tariffs that are going to effect in China and the current U.S.-China trade war are already prohibitive.
Right.
They are stopping the trade altogether. So it might not be a very effective policy tool.
What about India? Could you see India pivot away? And if so, how impactful would that be? Could you just put some perspective on it in terms of how much India currently buys from Russia and what their other options might be if they were disincentivized by these secondary tariffs?
India might indeed try to stay on the good side of President Trump. Clearly, there were some attempts to placate President Trump when it came to general tariffs not related to Russian oil trade. This would probably mean that India would have to bid more for oil from Gulf producers. This would effectively mean that India would be crowding out China from Persian Gulf oil market. This would mean that China would try to buy its oil elsewhere, and this leaves Russia. This might strengthen negotiating power of China towards Russia to some extent. It would leave China in slightly uncomfortable position because China tries to maintain its portfolio approach and not to be too dependent on any oil supplier, but that's most likely where it would end up.
Right. Okay. A clear perspective there. Let me ask you, Sergey, about a view you've got around Nord Stream 2, because I think it's quite fascinating here. You think that we could potentially see the restart of the Nord Stream 2 gas pipeline, but under U.S. ownership. Just talk us through what would need to happen to end up in that scenario.
There was an enterprising U.S. private capitalist, Stephen Lynch, who for almost 2 years was trying to get into negotiations, not even buy, but get into negotiations about possibly buying Nord Stream 2 assets, not the Nord Stream 2 company altogether. If you remember, when Nord Streams were exploded, one of the strands, and that happened to be Nord Stream 2 pipeline, escaped being punctured, so it's still alive, still filled with gas, could be turned on any moment, technically, if Germany would agree to that. The other Nord Stream 2 pipeline could easily be mended, easily, spending $1 billion or so of dollars, but that's technically possible, and then Russia would be able to send 27.5 billion cubic meters of gas towards Europe, technically. But then commercially and politically, there are many, many issues. On one hand, Germany in general and Europe might probably like to see more gas in their Russian gas in their energy mix if there is some sort of resolution between Russia and Ukraine. If it wouldn't be too disgusting for them to buy Russian gas.
Right.
It was quite expensive for them to switch to LNG.
Yeah.
They would love to get their gas cheaper. Russia would love to sell more of its gas because currently its gas is stranded.
Yeah.
US would probably love to have some control of Russian-European gas trade. On the other hand, this is an anathema for Ukraine. That construction of Nord Stream 2 was something that Ukraine was fighting tooth and nail back in 2018, 2019.
Yeah.
It would mean that Ukraine is sort of excluded from European-Russian gas relationship. But also for the US, Nord Stream 2 is a competitor for LNG that is coming from the US Gulf Coast.
Right.
And there are much more of LNG that is poised to come to market in the next couple of years.
Yeah.
So this is a very complex deal with probably low probability of happening.
Well, appreciate the framework that could get us there. Sergey, we'll have to leave it there. Sergey Vakulenko, Senior Fellow at Carnegie Russia Eurasia Center, former Head of Strategy at Gazprom Neft. Spain has vowed to hit NATO's defense spending goal of 2% of GDP this year. Spanish Prime Minister Pedro Sanchez said the country would contribute to defending Europe as he brought forward Spain's previous self-imposed deadline of 2029.
Nuestro objetivo es modernizar.
Our objective is to modernize security and defense capabilities in Spain and Europe with a comprehensive 360-degree perspective, mainly focusing on three things. First, the improvement of the conditions of our armed forces. Second, the modernization of our equipment. And third, the development of new technologies, with a priority focus on those dual-use applications and devices that can serve both military and civilian purposes.
Speaking to Carolyn in Washington, D.C., European Investment Bank President Nadia Calvino said countries across Europe are doing more to strengthen security.
Unfortunately, because I would really wish, that we were not having these conflicts very close to home. But unfortunately, it's clear that we need to reinforce and step up our support to Europe's security and defense capabilities. Last year in 2024, we started to get ready and expand our mandate. And this year, we have expanded it further so that we will ingrain security and defense as one of our core objectives in all our projects. And we will certainly increase our financing in this area. We doubled our investments last year. We are expecting to more than double in 2025 again and make a difference in terms of the security and the strategic autonomy of Europe in these troubling times.
Can I ask you, though, you have a balance sheet of around 600 billion euros. You, as you say, want to double the financing for defense to 2 billion euros this year, 2025, up to 8 billion in a few years' time. If you take that into perspective, given the size of your balance sheets, these numbers still look relatively small. Shouldn't more be done on this front?
Well, financing is not the constraint right now. We are working on a very solid pipeline of 22 projects, which I hope will be approved in the coming months. We have recently also removed the 8 billion ceiling, so we will be able to respond to the needs of the European Union right now and contribute, together with other institutions, to reinforce Europe's capabilities. But let me argue that I think that every euro financed by the European Investment Bank is actually contributing to Europe's security, because security starts with a strong economy, and our investments in energy infrastructures, in research and development, new technologies, water, all of these investments are making Europe stronger and contributing to a safer, more stable world.
Coming up on the show, tariff uncertainty takes to the skies. We'll discuss how geopolitical conflict weighs on the aviation industry next.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
In addition to hedge funds and registered advisors, Interactive Brokers also serves individual investors. We give you all the tools and technology we build for our institutional clients for free. Let Interactive Brokers assist you with your market goals. The best informed investors choose Interactive Brokers.
On the next Converge, meet rising next generation leaders shaping tomorrow today.
Keep on learning. Never be satisfied with just today's outcome.
It is our responsibility to adapt. However, I think it is also important not to compromise on your values.
Whatever decision we make as a company, we always keep in our mind, what good can this do for our country as well?
Doing good for business and society are not mutually exclusive.
Find out how they're redefining leadership on the next Converge.
Can't miss reporting that impacts your money now. Be here when the opening bell rings. Squawk on the Street. CNBC.
Welcome back. Boeing has agreed to sell part of its digital aviation solutions business, including navigation unit Jeppesen, to private equity firm Thoma Bravo for $10.55 billion. The deal is part of CEO Kelly Ortberg's plan to sell off non-core assets to reduce debt. We'll hear from Boeing CEO Kelly Ortberg in a CNBC exclusive interview after their earnings today at 2 p.m. London time. Anita Mendirata, founder of Anita Mendirata and Associates, joins me now. Anita, always a pleasure to speak with you. Let me kick off ahead of Boeing's earnings later today with this news out last week reported by Bloomberg that China has asked its domestic carriers to stop accepting delivery of Boeing aircraft. So Boeing right in the center of U.S.-China trade relations, right in the center of the trade war. What does this mean for Boeing?
This is a massive, massive strike against Boeing, which is really quite sad because if you think about it, as Kelly Ortberg said in the annual report just recently released, that this is the most consequential year for the history of Boeing in its 108 years. As you've said, we have our first quarter results coming out later today, and the noise within Boeing last year has now become outside of Boeing. The CEO has led the organization through some remarkable changes in the first 8 months of his leadership, and now we have this strike coming from the outside with trade tensions between the U.S. and China costing Boeing significantly. We're anticipating 179 aircraft have been canceled across 3 different Chinese airlines, and this is going to cost cash flow impact up until 2027 about $1.2 billion. So this is really unfortunate for Boeing as it's outside of its control, and it's definitely facing collateral damage of the trade tensions taking place internationally.
Anita, can Boeing redirect those aircraft that were destined for China to other Asian carriers?
There's definitely the possibility of that, but then it comes back to, again, tariffs. Because ultimately, as though Boeing is manufacturing and assembling in the U.S., many of the parts coming in for those aircraft are through supply chains internationally, and the costs are going up. The life cycle as well of actually creating, or rather the gestation period of creating an aircraft takes time. Is there an opportunity? Definitely. But it's going to mean a required shuffle of the aircraft deliveries, which, as we know, are fundamentally important to maintain the revenues and cash flow that Boeing is very much needed to meet its anticipated goal of being cash flow positive by the middle of this year.
Can imagine it's also, from China's perspective anyway, also a major headwind for their domestic travel agenda. At the same time, President Xi's trying to boost consumption, boost travel domestically, and if they're sitting there with fewer planes, that's got to be a difficult situation for President Xi. Let me ask you, Anita, who wins here? Given Boeing is clearly in a difficult predicament, does all of this mean good news for Airbus?
Technically, no one wins, and especially, and your question is so important, because from an airline industry perspective, an aircraft industry perspective, we have Airbus, as we know, as a competitor, which is no doubt facing also pressures in terms of elevated delivery demands and also new customer orders. But again, they were also struggling going into 2025 with being able to meet the demand levels of existing deliveries. We have COMAC, which is China's ultimately their new manufacturing of aircraft, which is very much taking in their minds the best of Boeing and Airbus technology, especially sustainable aviation technology, but we still have regulator approvals required for Europe and for the US. So ultimately, the demand that's going to be put now on the airline industry is affecting not only the aircraft manufacturers, the airlines, but also we as the flying public and the trade environment, as it puts enormous pressure on the ability to put aircraft in the air at times when already already the aviation industry is feeling the challenges of traveler sentiment shifting away from primary markets of travel demand during the summer season, and that's requiring a scramble equally of airlines needing to change their routes because there simply are not the forward bookings from a traveler perspective. So it's going to be a very complicated next quarter when it comes to being able to keep the aviation economy and the tourism economy buoyant, with all of these tensions keeping people away from flying to certain markets and ultimately from buying certain aircraft.
Anita, really appreciate the comprehensive view. Always a pleasure. Anita Menderata, founder, Anita and Menderata and Associates. We'll leave you with a check of European equity markets, which are trading in the green following the boom on Wall Street yesterday. The Xetra DAX now up more than 3%. U.S. futures also in the green, looking to add to yesterday's gains. That's it for Street Signs. I'm Juliana Tattlebaum. Worldwide Exchange is coming your way next.
CNBC meets David Beckham.
For a long time, people wanted me to do the life documentary, but I'm not very good at opening up. The things that I've been through in the past, I've kind of put in a box, locked it up, and thought I'm never going to have to talk about it again. And I was happy with that. But I didn't realize how important it was for me to actually talk about this stuff. So I opened up and talked about things that I'd never spoke about before, like, you know, injuries and worries and things that went on throughout my career, you know, the sending off and how that made me feel.
When you talk about the sending off and the reaction to it, when you look back, what kind of mental resilience?
Well, I'm really glad social media wasn't around back then, because it was bad enough then. It was challenging, and when I look back at some of the footage, some of the archive stuff I'd never seen before, and it was hard to watch, and I get emotional talking about it.
Home to the world's biggest population and a fast-growing economy. Is the EV story resonating amongst Indian consumers? CNBC goes inside India to give you insights into the opportunities and challenges shaping the emerging powerhouse. Narendra Modi seeks a historic third term.
Several indicators they cannot afford to look the other way.
It's all part of the normal flow of market forces.
The stories, people and businesses behind its rise. This is your gateway to India.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
Wow, that's exciting. People are not afraid to relax. Oh my God. So this is my family's go-to spot, and it's always so good. My name is Chad Kubanoff. I've been living in Ho Chi Minh City for close to a decade now. This really is like the steak and eggs in Vietnam. I love Vietnamese cuisine because it like crosses lines all the time. Like, is this a salad? Is this a noodle bowl? It's somewhere in between, and I think that's really exciting when you see dishes like that. I was reluctant to show you this spot because I love it so much, and I don't want it to get any busier. And it's so cool in Ho Chi Minh City because there's so many different styles of coffee shops, and no matter what you're into, there's something for you. If you want something that's a little more chilled, there's absolutely that. Or you want something that has a lot of koi fish, they have that as well. We can't be in Saigon without talking about Kum Tam or broken rice, which is like the dish of this city. After 10 years of living here, my palate has completely changed as a cook and as an eater. I love this kind of eating. This is what made me fall in love with Vietnam. Welcome to my neighborhood. Let me show you a few spots I love to go to in my downtime.
None whatsoever. No, I have no intention of firing him.
Donald Trump does an about-face on Fed Chair Jerome Powell, and investors, they are responding, sparking a wave of buying all around the world. Futures here, they are solidly higher, also helping out. The president suggesting that tariffs on China those may come down.
145% is very high, and it won't be that high. It'll come down substantially.
And Tesla rising after earnings, with Elon Musk signaling it's time to get back to work. It is Wednesday, April the 23rd, 2025, and this is Worldwide Exchange on CNBC. And good morning. Thanks so much for being here with us. I am Frank Holland. Let's get you ready for this trading day ahead. We begin with U.S. futures and the Dow and the NASDAQ, both of them breaking a 4-day losing streak. Take a look at futures. You can see we are in the green across the board. Right now, it looks like the Dow would open about 600 points higher. The NASDAQ doing the best on a percentage basis, up just about 2.5%. So this action after the president said he's going to be, quote unquote, nice when it comes to a China trade deal. Also adding he has no plans to fire Fed Chair Jerome Powell.